Hi, a very good morning from Singapore. My name is Mark and welcome to WWTD 2022. That's right, this is Tiger Brokers Weekend here. A quick shout out to all of you that are joining us live from YouTube as well as on our Tiger app. Okay, before I proceed any further, let us know wherever you're from. I understand that we got guests from all over the world, different time zones. So just comment down below in the comment section. Hi, I'm from Philippines, I'm from China, I'm from US, wherever you are. Welcome, welcome. We've got 4 teams we'll be going through today. So let me just walk with you through that, okay? We'll be looking back at 2021, okay? We'll be looking forward right in this year, 2022, the geographical outlook, as well as the mega trends, and last but not least, the thematic outlook, all right? Thematic market outlook for 2022. That's what we'll be covering today and today only. But bear in mind, this is a weekend affair, okay? We've got many things coming up for the weekend, one of which as well is our experience store, all right? So stay tuned for that. Let me just check in, okay? All right. Okay, thanks for your patience. Okay, we're going to just wait for it to come up. Experience store is happening, that's right, at Tiong Bahru, okay, today and tomorrow, Yong Siak Street from 9 a.m. to 8 p.m., okay? That's right. And here's the thing, we've got lots of amazing prizes to give away there as well, okay? Location 7 Yong Siak Street, okay? Here are the prizes we'll be giving away. Commission-free vouchers, $50 to $100 stock vouchers, 888 Tiger coins, because this year is the year of the Tiger. Chinese New Year has come early for us. Okay, last but not least, we got limited edition Tiger Brokers merchandise and Apple AirTag. Okay, so these are the participating outlets, and they are Drips Bakery Cafe, Chapter 55, Tian's, and Oh Shifu. All right, charcoal porridge. Now, bear in mind, when you go around this experience store area, there's also one more thing for you to do, and that is to find our Tiger dolls, and get a chance to win some amazing prizes I mentioned earlier on. All right, fret not, for those of you that are not driving, we've got shuttle bus for you. All right, it's from 9 a.m. to 7 p.m. Okay, so very exciting stuff happening here live, as well as if you want to lighten the mood, head on down to Tiong Bahru area, okay? This is the free shuttle service, once again, provided for you and your loved ones, okay? All right, so without further ado, enough of me talking. I'll hand over the time now to a video segment, okay? So feast your eyes. Your very first course for this webinar is the video segment about the experience store. Stay tuned. That's right, that's what's happening at our experience store. But let's move back now to our webinar whole, WWTD, Investing Tomorrow, Today. We're going to kick things off with a panel discussion about what happened last year in 2021. So without further ado, I'm going to hand over the time now to Chief Financial Officer at Tiger Brokers, Mr. Henry Cho, for the panel discussion. Mr. Henry, please.
Good morning and welcome to WWTD 2022. Tiger Brokers' inaugural Investor Outlook event. My name is Henry. I'm proud to be part of the team in Tiger Brokers Singapore. WWTD stands for What Would Tiger Do? So we aim to give you a snapshot of what happened in the last 12 months, what might happen in the next 12. And we've invited a panel of experts who will be sharing with us their views in their subject expert, what their allocation could look like in the next 12 months. And we hope with that, it helps you in your investment journey this year. And you have heard from Mark, at Tiger Brokers, it's not all work and no play. The team has organized an experience store at number 7 Yong Siak Street, Tiong Bahru. In this experience store, there's exciting games that you can play and obviously attractive prizes that you can win. But the bigger takeaway that we want you to go away with is that investing doesn't need to be stressful. It can be fun if you plan it in advance. And hence we adopt the theme, investing tomorrow, today. And you also seen earlier, we have arranged with a bunch of local businesses who have somewhat suffered during the COVID-19 period. Now, as economy starts to open up again, we want to put them back in front of you. So when you spend your next dollar, perhaps you can think about supporting local businesses. Maybe we can all work together to support these businesses. Help support them by going through the WWTD landing pages where you get more details on there. So with that, I want to welcome you once again, and I wish that you have a fulfilling 2 days with us. Okay, I want to start by going through the next segment, looking back to 2021. These are just some of my sharing from what we could see from our trading customers. Some brief background. The economies in 2021 has all been growing. You see US growing at 5.6%. You see China growing at a whopping 8%. UK was about 6.5%. Asia on the whole was 7%. In particular, Singapore was 5.4%. Now, overall economies has been growing very healthily, but mostly because in 2020, the world had an upset. COVID-19 brought all the GDP down. So 2021, we all start from a low base. Things could be quite different in 2022. With the onset of inflation risks and with the onset of interest rate and liquidity risks, the economy could look somewhat different. If you look at the stock market, now S&P as an index hit record high 70 times in 2021. Are they about to repeat themselves in 2022? Energy and real estate sector were the best performing sectors in S&P last year, each clocking about 40% gain. Technology and financials are up about 30%. Now, energies, commodities, these are pretty much cyclical stuff. Real estate could be affected by tightening monetary policy that's likely to onset in 2022 all over the world. And our thoughts are financials are likely to continue to perform well in 2022 as they tend to in an interest rate rising environment. In 2021, there was also a development of a new quirk investment. A struggling video game retailer, probably from the last century, suddenly gained a lot of fame and jumped up 2,700%. GameStop is a company that many of us hardly heard of. Suddenly it became part of the portfolio for many, many people, right? Now, the bigger takeaway on this event was that the power of retailers coming together against the Wall Street people. And that was a power that now has proven to be something that is strong enough to upset them. Now, eventually the foray died, but GameStop still ended the year up about 700%. It's not too bad. So what to me personally is interesting is the emergence of popular medium that could jive people together for a concerted movement against bigger boys. Right, and obviously, COVID was still very much in the picture in 2021. It was here in 19, it was here in 20, and in 21. Is it likely to be here again still in 22? Let's see. In 2021, we discovered the Delta strain, right, and it became prevalent. Everyone was afraid of it. Vaccination becomes the rule of law in many places. We end the year with the discovery of Omicron. Now, will it become a mainstream again? Is it going to be as harmful as before? We don't know. But what we saw was that very swiftly, and this is unlike in 2020, the government of the world took very swift measures to shut down their borders to stop flights. So in our view, two things. Number one, airline stocks or related stuff, hotels and all, is something that's likely to be volatile until COVID is gone. We don't know where that is, but it's something that we will probably stay on the side for now. And the other thing we realize is now half the world is very, very well acquainted with the ancient Greek alphabets. Thank you. Okay, good morning everyone. Welcome back again and welcome to our first panel discussion of WWTD 2022. I'm very honored to have the following experts with us. Let me quickly introduce them. Chu Chen. Chu Chen is the Director of Macro Strategy and Multi-Asset from UOB Asset Management. Right next to him, Clement. Clement heads up the retail space in Southeast Asia for Franklin Templeton. And right next to him, Ling Pang Chi from Fidelity International. He heads up the Singapore retail space. And gentleman right at the end, Mr. Lim Yun from Lion Global Investors, and he is the Chief Investment Strategist there. A very warm welcome. Right. In this section, what we want to cover is what are some of the winners and what are some of the losers that we saw in 2021. I did a very quick scheme of the market before this event, and there were 4 winners that was noted. Pharmaceutical, semiconductor, energy, and EV. This is not surprising to anyone at all. Losers, medias and entertainment. For example, Walt Disney. They didn't do very well last year. People say that it's because of the shutdown of the theme parks and all. Well, let's see how are they going to do this year. Right. I just want to go to my panel and check with them what are their views in their subject expert. So maybe Chu Chen, you can share with us cyclical in terms of energy, in terms of real estate. How does it look like in 2022? What's your view? What's your take in this space?
Sure. Thank you, Henry. Let me start off with a little bit of a macro backdrop on what happened last year before we go into what we expect for this coming year. I think for last year, what we observed was that growth was above market expectations, and also even inflation was above market expectations. But let me share first on the growth part. I think what we saw was green shoots coming out from a recession that was pretty serious that we saw. It was a very sharp drawdown. But actually after that, the green shoots grew. And actually, I would say that these are not just green shoots, but actually bamboo shoots. Bamboo shoots in the sense that this is actually pretty durable. They grow very fast and they grow strong. So I think that was what we saw last year, in particular, for example, like in the US, where we saw the growth picking up pretty strong and is reaching pretty high levels that we saw. And I think one of the key, and you can see that against a backdrop against, for example, how the vaccines were able to let the economy continue to grow. So even though, for example, Delta variant came along, and also even the Omicron towards the end of the year, we saw the vaccines roll out and the effectiveness was pretty much in line or even a little bit above what people thought at that time. So I think this helped with the recovery, so that set the stage for pretty strong growth that we saw. And I think not only that, it even withstood the energy crunch in the later part of the year we saw as well. So I think let me just start by saying that growth was above expectations. I think the other part to note would be on the inflation part, where I think initially people thought that COVID-19 would have just been a pretty, cause some temporary disruptions and that it would be transitory. And I think on that front, even in the US, the Fed thought that it was transitory, although market thought somewhat otherwise. But I think what happened was that COVID-19 was actually, so while growth by right should lead to inflation, but COVID-19 itself actually caused both temporary and as well as somewhat semi-secular, structural threats to go through. So I think one of the clear examples would be, for example, on the wage front and on the labor market. Like even last night, pretty much the numbers was a little bit weak, but actually we saw the labor participation force still kind of still hovering below the pre-pandemic levels, suggesting that actually people are still thinking about kind of like not really wanting to re-enter the workforce. And basically this has caused some change in dynamics that, well, in Asia we may not see it, but clearly in other parts of the world, like in the US, they're thinking about how they want to live their lives, how they want to work, and it changes their mind, their psyche pretty differently. And so against that backdrop, we saw inflation pick up. And then after that, what people thought it would actually come down, but actually it stayed pretty high and pretty much through the rest of the year. And again, exacerbated by the energy crunch and by all the disruptions and the shortages. So I think that was the backdrop that we saw. And I think even though that was that, growth held up. And against this backdrop, I would say that actually the winners of this macro backdrop would be those that benefit from high growth and high inflation. So on this front, as you shared earlier, I think this would be the cyclicals bucket, cyclicals that can do well in this environment, assets including, for example, commodities, value plays, growth plays, and also in the real estate front, real assets front, we have the real estate, we have the REITs, and we also have the infrastructure. So I think there are different themes, drivers for each of these two buckets. But overall, I would say that the whole idea was that in the growth, you want to be latched onto the growth. You do not want your margins to be eroded, and you want to be in some sort of monopolistic market demand. But the demand is inelastic, and you can withstand the rise the rise in rates. Yeah, so I think that was what did very well last year. And going forward this year, of course, there are pretty much changes that we saw. And one of the key themes will obviously be the Fed, where we saw the pivot that happened in December. Again, market was actually kind of already ahead of them. And finally, the Fed picked up. Finally, they acknowledged that this is actually not so transitory. And therefore, with the pivot, we saw that then this year, then they reinforced the message. And clearly, the markets was in kind of a bit of a ride at the start of this year. So, well, I hope Chinese New Year will be, not so rocky. But certainly for the start of the year, it was a bit of a rocky ride. But again, I would again say that this is actually a healthy withdrawal in liquidity. I think one of the key reasons was that the Fed, they used the old playbook that they had, and they wanted to assure the markets that they will do what it takes to keep rates low. But in the process, I think some of the markets became bubbly, for example, the housing market, and that led to some of the inflation pressures being stronger than expected. And therefore, against that backdrop, they should actually put down the QT should come in to stop the bubbling, housing price, rents, shelter inflation. They've done that. We should expect that somewhat to come in soon. And therefore, this is a healthy correction of excess liquidity. And again, I think there's some concerns from the audience that this may derail markets or we may expect less returns. But I would say that it may lower near-term growth, but it will actually be good for longer-term growth. It reduces the risk to longer-term growth. So I think against that backdrop, we remain positive on cyclicals and real assets.
Right. Thank you. What about Lim Win? What's your take on these cyclical asset classes?
Yeah, I think, if we take a step back, 2019, like you mentioned, 2020, 2021 were very good years for the equity markets, right? And it was a big surprise for everybody, right? Because last year we had COVID, right? Where it was at its worst, but the market continued to go on. So one of the main factors we think is because of the excess liquidity that's entering into the system itself. So if you use that as a backdrop, going into 2022, I think there are three main issues that you have to think about. One, which is actually the Omicron virus itself, or should we say that, are we actually transitioning into a post-COVID world, right? When I say post-COVID, it means, I'm not saying that that's the end of the pandemic. It just means that we go into an endemic kind of a phase whereby everybody lives with it. So a reopening of the society itself, by and large. The second thing that you have to look out for is, you have actually mentioned, this rate hike cycle. The whole world is going into a tightening cycle now, right? Except for China. And lastly, what we have to think about is whether this loosening that's starting in China, how is that going to affect the growth in Asia itself? So by and large, I've actually three conclusions over here. One conclusion is that this preference for growth stock probably will take a temper for the time being. It will slow down for the time being. For 2022, we could actually be looking at a phase whereby people will be looking at reopening itself, meaning that the cyclical stocks could actually do well for this year. The second theme that is actually growth is not dead, right? As the past 3 years or so has actually taught us, a lot of these habits that we have actually inculcated, for example, buying on the internet itself, online education, and so on and so forth, these things are not going to reverse. So there's actually a long-term secular trend for a lot of these themes itself. So just now I mentioned, cyclicals might have a comeback in 2022, but that said, in the longer term, it's still worth investing in the growth stocks. And finally, I think the million-dollar question now over for investors would be, what about China, right? Last year, the Chinese market actually corrected, and this is on a tightening cycle. The Chinese have actually introduced a lot of new regulations, in the name of common prosperity. What we think is that this is actually an overall reform for them to actually achieve sustainable and equitable growth for the whole country. So in the longer run, it's actually a very positive sign. Just as I've actually mentioned, the most of the world, we are looking at tightening. So in the States, we are talking about tapering could probably end in June or earlier, right? They will actually accelerate the tapering towards the April period. So it could actually end earlier. We are looking at 3 rate hikes for this year, and that could actually start as early as the third quarter of this year. And can you imagine, the central bank in US is talking about not only tapering, which is a slowdown in the purchase of assets itself, but also tightening itself. So what we could actually, imagine is that the whole world is actually tightening, right? The US market has done really well last year, but on the reverse, the Chinese are just starting to loosen. So what we are talking about is the triple R cut. We are talking about them actually lowering the lending rates over there. And there's also a possibility that it could actually increase the banking loan quota itself. So what we think is that there could be a good chance for this year when you actually get more loosening in the Chinese market itself. People could actually now reverse. The rebalancing could actually come from the States towards the Chinese market. So I leave with you a few thoughts over here. First, 2022 could be a year whereby cyclical markets could do well, right? Second thing, the Chinese market could actually have a reversal, could actually do better than everybody expected. And thirdly, in the long run, it's still worth investing in a lot of the growth stocks, technology stocks, or should I say the disruptive stocks.
Right. Thank you, Levin. Very interesting point. I just want to check, Clement, what's your take on the current situation with the technology companies, and do you see the tech companies still going up another 30% in 2022?
Sure, I think that's a great question. I think if you look at the marketplace today, there's been fundamental disruptions across businesses, commerce, and even on the social level as well, right? In fact, before I answer your question directly, let me share with you, my conversation with Tiger. After all, this is what will Tiger do in 2022, right? So I actually asked him out for coffee last week. Unfortunately, he couldn't join me in person because one of his housemates caught COVID. So we had to set up a Zoom call. And these days, I'm so excited to do Zoom calls simply because I have a very nice curved 40-inch monitor and a very nice, Bluetooth noise cancellation headphone, which my company invested into for me, right, as part of the work from home procedures. So we started that Zoom call with Tiger, and I asked, hey, Tiger, what we do in 2022? Obviously, he was a bit distracted as usual. He was saying, oh, Clement, I have so many things on my buy list. I just hope that bonus this year will be good for me. So he said, first thing he wanted was a brand new 5G, 108 megapixel mobile phone. I said, all right, that's cool. Because, he's very much into playing online games. He's very much, and he's thinking of exploring the metaverse. And that's why he's also thinking of buying, the Oculus VR goggles. And not only that, he's also thinking, and this is his biggest dream, right, which is to buy the Tesla Model 3, which has just launched in Singapore. So as you can see from that conversation, I think it's quite clear that there's a new mega trend that's been very much talked about. And I think the great pandemic has been a catalyst to digital transformation, giving rise to this digital mega trend. Technology has evolved so much over the last 2-3 years. It's caused so much disruption socially, and as one simple example is in the workplace. And traditionally, we would be doing this panel in front of an audience of a few hundred people at World Trade Center, Suntec. But the fact that all of us are gathered here today using, the latest technology, beaming across, Singapore, Southeast Asia, and the rest of the world, I think that says a lot to the outcome. Now, talking about returns. So 2021, tech sector was indeed one of the better performing sectors across the board. Just using the Franklin Technology Fund as an example, we returned over 20% last year, 2021. But more importantly, over the last 10 years, we've averaged 20% per annum across the last 10 years as well. So I can't guarantee you, I can't predict what we're going to return this year for 2022. But I think based on the digital transformation megatrend that we've witnessed, and which the great pandemic has accelerated, I think we're in for some exciting times.
Right. I just have one follow-on question for you, Clement. Now, when you talk about the technology sector, there are obviously the very new one, which you're talking about, the EVs and all, and then there's the very old industry, say for example, Seagate, the hard disk industry. Now, they all they all improved last year, and part of the reason for that, the new one, obviously, there are people chasing after the technology. Now, the old ones, like the hard disk technology, they were thriving simply because of the shortage of parts. The supplies coming on was a stranglehold for them. Coupled with the fact that development of some crypto, instead of very CPU-based processing, they now uses hard disk space. That resulted Seagate, for some strange reason, broke $110. I remember it. Do you see, what's your take on this shortage on silicon supply, chip supply, and when do you think it will last till?
I think that's part of a broader question. I think clearly, in this pandemic era, there's been a lot of supply constraints, not just across, physical assets, but also, across the talent pool as well. I think, if you read the news, the Great Resignation is a big topic, where there are tons or hundreds of thousands or millions of people across the world resigning, changing vocations, and even in the technology space, we do see a shortage of talent, right? So supply constraint, both in terms of physical assets as well as talent, may cause somewhat of a damper. But at the same time, if you think about 5, 10, 20 years ahead, many of the jobs that exist today will no longer be relevant in 20, 30 years' time. Interesting story, my girl's in primary school, and the teacher made a remark. She said, hey, if you're not good in studies, that's fine. As long as you're good with Photoshop, you know how to use a camera, and you have an Instagram or TikTok account, you should be fine. In fact, you probably make more than your parents. So I was absolutely flabbergasted to hear my girl say that, or for her teacher to actually say that to her. But I think there's some truth in that, right? Because we're going towards a new economy. So whilst we have supply crunches for now, I think as the pandemic eases, as borders reopen, we'll start to see that explosive growth once again. Now, one of the mega trends that we talked about earlier, and which you mentioned as well, is that of electric vehicles, right? So I gave the example of Tiger buying that new Model 3. It's a dream for me. I can't afford it right now. But I think it's the aspirations of many millennials out there, right? To drive a cool EV car, and especially, And what's really important is this. If you take a step back and look at the entire, potential of the EV segment, it's really, really mind-blowing, okay? Now, what's the global car population? Any guesses?
I've got no idea.
It's 1.4 billion passenger vehicles on a global basis right now, okay? So let's put a number, 1.4 billion. And then you look at, the recent announcements made by the UK that they're going to stop the sale of all new petrol or diesel engines by 2030. Here in Singapore, the government has a slightly longer timeline. I'm going to stop, all ICE, internal combustion engine sales, by 2040. And that's not too far away. In the UK, 2030 is just 8 years away, right? Singapore is just another, 18 years. So if there's a 1.4 billion opportunity, replacement opportunity out there, right, then this has just created a whole new market by itself. And who are the current leaders in this space? Tesla, right? Tesla is a well-known global, electric vehicle manufacturer. And what's really interesting is that the profit margins on the Tesla Model 3, which is their basic model, is between 25 to 30+%, depending on which markets they're in and which operating model. So it's relatively high margin versus a huge replacement potential. Another fun fact, what is the market cap of Tesla? So Tesla's market cap has just crossed the US 1 trillion mark. So what's the significance of that? That equates to the combined market cap of the top 5 traditional automobile manufacturers. So, and what are the top 5? It's Toyota, Volkswagen, Daimler, which is Mercedes, Ford Motor, as well as General Motors. So one EV car manufacturer has the same market cap as 5 traditional, automobile manufacturers as of now. I think there's a huge potential in the EV space. And Tesla, isn't the only name out there, right? We also have Lucid. So Tesla competes in the mass market segment. Lucid is for, enthusiasts, people who can afford the Porsches, 911s of the world. So Lucid produces luxury sports EV models. And I think the latest model, Lucid Air, has over 1,100 horsepower, has a range of over 500 miles, etc. I mean, the stats are just mind-boggling. And then we also have, and if you look at the stock market price of Lucid, I think it just popped 5.5% last night. Now, I'm not making any stock recommendations here. I'm just highlighting some of these names to illustrate the potential that we see within the EV segment. And EV isn't just about passenger cars, right? It's also about commercial vehicles, school buses, your tractors, your SAMIs, as they are called in the US, your construction vehicles as well, which are extremely polluting. So we also have another name, which is Proterra. We are specialists in the commercial area. And just last night, I was reading a research report talking about this new company called Rivian that's just committed $5 billion to produce a new EV factory producing commercial vehicles. And they planned to have an annual production of about 450,000 commercial vehicles. So I'm glad you mentioned, EV as a topic. I think it's extremely interesting. There are many ways to play this space. You could go directly into the manufacturers, or you could go into indirectly, right? Via, some of the, for example, very often EVs are called iPhones on wheels, right? Because it's all about software. If you look in the Tesla tree, a large chunk of it is a really large, super big iPad. And there may be like 30 apps on each page. So we're also excited about things like, Spotify, subscription-based revenue, right? Because if you're driving your Tesla, you're going to want to listen to music, and you want to play your Spotify soundtracks. So we're also interested, in ways that you can indirectly play this theme. Spotify, Netflix. Another very interesting fact is it takes about 45 minutes for a quick charge, about 2 hours for a full charge. And 45 minutes is just about the average time a Netflix episode lasts, or 2 hours is just about the average time a movie lasts. So you could essentially Netflix and charge at the same time, right? So I think, it's just amazing how EVs have taken off. You could play it from the manufacturer perspective. You could play it indirectly, through some of the subscription-based revenue models that are coming up with the event of such a new technology. So sorry I took about too much time, but I'm just so excited about the EV space.
Right. No, thank you very much. And for those who are interested, you can actually load up Netflix in your Tesla and watch Netflix while you're charging. Anyway, let's move on to pharmaceutical. Pangchi, I just want to check with you. So obviously, 2020 and 21, 20 come out as a year where expectation was very high for pharmaceutical. And then 21 comes out as a year where the antidote has been found, and people expect pharmaceutical to have a super bull run. We saw that in Moderna, for example, but we actually didn't see the same kind of run in Pfizer, and actually Merck, for some strange reason, went under. What's your take on pharmaceutical, and maybe you could give us some clarity on what exactly is happening in this space?
Sure. And thanks a lot, Henry, for this. I think pharma is a very, is it the right way to say it? It's a bit of a misunderstood, or a bit of a subsector, right, of the global healthcare sector, which has got quite a lot of complexity in it, right? And I think if you look at performance profiles in general, right, across 2020, 2021, the broad, pharma sector itself has done well, but if you delve deeper into it, right, there are your big pharmas which have done well. There's your smaller caps. There's your Asia pharma stocks, which have arguably not done as well. Okay. So your point about Moderna, Pfizer, I won't go specific into names, right? But I just want to say that from a pharmaceutical business perspective, there are many things to link them apart from COVID developments and finding the antidote. I think that's a very convenient and intuitive way, if I may say, right, to sort of link the success of certain pharmaceutical companies to an antidote of a current pandemic that we're facing, right? But I think beyond this itself, right, I think there are other things we need to think about, which is, structurally, all these pharma companies, they thrive on R&D. They thrive on finding out new drugs, and this may not be COVID, right? Could be new insulin, type inducing drugs, or anything that's got to do with chronic illnesses, right? Cancer, AIDS, so on and so forth, right? So make no mistake about it. It's extremely high R&D, capital intensive kind of business, and we always have to ask, and this is what every pharma company will ask, right? What is the return on R&D, right? And ultimately, whatever we're spending now, right, is it going to come back to us in the form of drug sales, right? Simply put, if you're going to put in a lot of money and stuff, and at the end of, all these drugs are patented, right? And at the end of it, we see cyclically every, couple of years, there will be some kind of patent cliff, we call it. That's where, patents expire and things kind of fall off the cliff, because the drugs we invented is going to become like Panadol, right? It's generic and people can produce it, right? That's where our supernormal profits disappear, right? So I think a real thing to think about is that we put forth a view of a moderate view towards pharmaceuticals as a subsector of the global healthcare sector, which we think is much more exciting to sort of think about, particularly where we are now in terms of valuations, right? Let me expand on that. So we spoke a bit about patent losses, right? The whole landscape behind this is that all these pharma companies, big or small, they're going to try to reinvent, new things, put in money, and you'd see that in a recent report, which I read from Deloitte, returns from R&D across the sector, right, is actually less than 5%, right? So that's a very small kind of returns you're getting for the kind of money you're pumping in to reinvent something that is potentially world-changing, right? And likewise, returns on M&A activities. We all know it's an industry where, big players buy up smaller ones, upstream, downstream kind of mergers and acquisitions. We see a lot of that in this sector as well. It's also not showing as much value as the market expects it to, right? And market expectations are huge these days, right? So I think what we would advise, right, from Fidelity is look beyond farmers, because within the global healthcare sector, the broader one, right, there are things like medical devices, tools, life sciences, right? I think these are all areas of growth. They are not nearly as cyclical, right, as some of these pharma companies might be in, right? But I would say that the subsectors that I mentioned just now, medical sciences, life tools, I would argue that their growth has been slightly less appreciated compared to farmers under the huge COVID cloud that we're all under, right? So with regards to that, I think if you were to look at opportunities, we would advise look beyond pharma, right? Look into the broader global healthcare sector, where you could find some not just exciting, but underappreciated growth opportunities, right? So that's translating some views from my from our global healthcare manager, and hopefully this is useful to the audience.
Right. I mean, it's a very interesting observation, because If you look at a very simple one in Singapore, P-Life REIT, they are not exactly in the medical field, but they do own a bunch of hospitals. And if you guys have been, if anyone has been tracking their performance, you realize that for some strange reason, they have been stellar over the last year. But a common topic amongst the four experts here are two things. Number one, we talk about COVID and post-COVID, right? And then we talk about the interest rate and monetary policy. Now, I want to draw into this a little bit more, but I will leave monetary policy to the later part. I just want to go back to Lim Yun and check with you. In your opinion, in particular, something that you mentioned strikes me. The new habits that derive from COVID. What are the sectors in Singapore you think it's likely to be doing well in this space?
Well, I think, maybe let's take a step back a little bit. I just now I've actually introduced to everybody, three investment conclusions and also, three of the so-called themes or stories that investors should look out for in 2022. So that one aside, the other thing that everybody has got to remember is that in the investment world, everything is about time frame. So just now you sort of mentioned this excitement about technology. Actually, I don't like to use the word technology. I like to use, within tech itself, there's actually various segments, right? So there are the old technology companies that will be disrupted away. There will be the new ones that will eat the lunches of everybody else. And there are certain companies that are not really tech. They could be consumer, they come up with a new business model and they encroach into their tech space, so to speak. So actually just now you have actually asked one pertinent question, which is that global, let's say technology have done so well for the last 3 years. What's next for 2022? I think it's all about time frame. If you look at this year itself, for the tech space, because they have done so well precisely for 3 years itself, the valuations are actually very high, right? And second thing, there's this tendency for investors to actually to rebalance, meaning that they look for, it's a relative game, right? You look, the cyclicals have done so badly. Is there a chance for them to actually to rebound? The growth stocks that have done so well, the disruptive stocks have done so well, they have gone up so much, valuations are so high. So for this year, which is a better theme for you? I think it's all a matter about time frame. No doubt, in a longer term perspective, like just now I've actually mentioned to you, that a lot of these so-called technological teams itself, they have a long runway. So they will actually continue to grow going forward. But for 2022, what I'm saying is that they might take a pause. Purely because there could actually be better opportunities. So there's this trading opportunities that is available now. So what I'm mentioning, why am I mentioning this is because it fits to your question itself. Your question asked me, let's say, in Singapore, I think the biggest question is, what will happen in Singapore for the Singapore stock market itself? I think in Singapore stock market, fortunately or unfortunately, there's actually a huge segment of so-called old economy stocks. Those that are linked to, let's say, oil and gas, those that are linked to financials and so on and so forth. Then the question that you ask yourself is, are these stocks going to do better this year vis-a-vis last year? Then our expectation is that they could actually do better this year. The reason behind it is because, first, valuations are actually cheaper relative to the other countries out there. Second thing you can think of is this reopening trade. So it goes back to this question about Omicron, right? Is this going to be continuously become a problem? Meaning that, would we continue to be in a lockdown phase? If we are going to continue to be in a lockdown phase, then I think it will be challenging for Singapore stocks. As you probably know, Singapore is a very open economy. So the stock market actually does well when we are back in the normalized phase. So our base case is that, like what the Ministry of Health has actually mentioned, the Omicron could be more transmissible, but it's less severe, meaning that there's a lower so-called mortality rate. So people die less from it. People go to hospital less, in a percentage basis. And the most important thing is that the vaccines actually work against it. So this year could actually be a year whereby we actually transition into post-COVID, meaning that, if you look throughout the whole world, the vaccination rate has actually caught up. Most countries are at 80, 90% for the major developed countries. Even for the emerging countries, the vaccination rates are actually going up and catching up. So what will happen is that, we will transition from a so-called a lockdown, right, into something like, we'll be reopening. So that will actually be positive for the Singapore market, meaning that we could actually reopen, hospitality industries could actually do better, right? The hotel industries could do better, tourism could come back, international business could actually resume back in Singapore. So that will actually be positive for Singapore. Second issue, you talk about oil and gas, right? Actually, oil and gas is an old industry, right? People say, we will transition into new renewable energy and so on and so forth. But guess what? Again, it's about timing. It's about time frame. So in a long run, right? 5 years, 10 years down the road, we'll transition towards we won't use fossil fuel, so to speak. But in the meantime, we still need it. The irony behind it is this. Because of this move towards so-called a renewable, zero carbon, carbon neutrality kind of a society, companies are actually investing less in so-called fossil fuel, which means that there could actually be a supply tightness in the system itself. So what we are saying is that, for example, this year, right, or last year, 2021, you see that, you have a colder winter, right? Demand coming back because people, there's a little bit of reopening, people start driving, there's a little bit of so-called air travels and so on and so forth, right? And also because renewable energy at this moment is not so reliable, meaning that you can generate solar in the morning, right? But you need a space to store the energy in. And this storage is not developed yet in a lot of countries. Wind, likewise, sometimes there are wind, sometimes there are not, right? So renewable is not so reliable, which actually causes, a energy crunch last year, right? So you have a cold winter, you have a reopening, and then you actually have this under capex for the last few years. So which means that in a small time frame, right, for the next 1 year or so, energy prices could actually remain at a high level, which is actually positive for the oil and gas industry here in Singapore. And lastly, rate hike cycle, right? Isn't that great for the banking sector itself? So again, it's all about timing, right? So if you're an investor, is your time frame a 10 years time frame, or is your time frame a 1 year time frame? It's a very pertinent question. You got to think carefully about that. Our view is that for this year, with reopening, rate hike, right? Opening of travels itself is probably positive for the Singapore market. But that said, because of this withdrawal of liquidity in the system itself, this year is not going to be a year whereby it's so easy, right? Whereby it's a beta, it's a risk on or risk off bet. You put your money into the market, and most of the sectors actually rally. This is not going to be a year like this, because for the last 3 years, the stock market has done so well on actually the back of this excess liquidity and entering into the system itself. This year is when the liquidity is actually stopping and actually being taken out of the system itself. So this is a year whereby you have to be more selective. You should actually pick the markets, pick the sectors carefully. That's all. Back to you, Henry.
Right. Thank you.
Yeah, no, actually, that was a great comment by my fellow panelists about, time frame and valuations. And I think this also applies to the technology space, right? Let's start on the easier topic of valuations. So technology, as you're all aware, has always traded above, global indices at a premium. So as of November last year, the tech premium, over say S&P 500 was about 30%. In December, we saw some pullback after the dovish comments from the Fed, and that premium is now about 20%. As always, and that brings me to the next question on time frame. For technology, much of what we see today, there's a lot of talk about the metaverse, Decentraland, right? All these, there's a lot of talk as well. I mentioned about commercial EV, right? These are not things that are going to happen overnight. These are things that are not going to necessarily happen in 2022. But very often, as you read the research reports, many of the analysts, give it 2025, 26 before, some of these companies actually turn profitable. Okay, so back to your question, what will work or what will do well in 2022? We think technology as a whole will do well, but as always, it's always good for investors to keep a longer time frame. So there's this antidote that Jonathan Curtis, portfolio manager of the Franklin Tech Fund, always says. He always gives the example of Amazon, right? So back in 2007, he bought into Amazon when it was a 30B company. Valuations, I can't remember, I think it was like 40 times book of forward earnings, one of them. And it was a crazy amount to pay back in 2007. But today, it's a 1.7 trillion market cap company. If he had not invested in Amazon back then, and if Amazon had not invented AWS, their cloud-based service, we would have missed out on a very, very nice run over a very long time frame. So as always, with specific to the technologies sector, again, I agree with my panelists as well. Not all tech firms are equal. You need an expert to pick out the winners from the losers.
Right.
And on that note, what we do is we also look at private unlisted companies, right? I think looking at the private unlisted space is very important because that gives you a quick pulse, and that's spelled P-U-L-S-E, on what the future brings for current tech giants of today. So if we're looking at a private unlisted company that has put maybe technology that will unseat Facebook or Meta or Google or AWS, then that will give us a sense of where technology is heading and who will be the future winners or losers over the next 5 to 10 years. Yeah. So thank you for your comments. I fully agree with you that time frame as well as valuations are very important when investing.
Thank you, Clement. So the other thing that we have been touching on is monetary policy, the buybacks, increasing of rates 3 times at least in 2022. If I recall correctly, UK has already done the first rate increase. I just want to check with Chu Chen, what's your house view on fixed income given this kind of backdrop? Where are you recommending people to go to, and how is your rebalancing of your duration looking like now?
Thank you. Yes, right now we are actually overweight the commodities, the equities, and also the real assets space. We are underweight fixed income, precisely for the reason that you shared, basically the interest rate hike. Actually, I would say that in terms of the rate hikes that is in the market, it's actually already pretty much in the market, in the sense that already now the US market is expecting 3 to 4 rate hikes this year, I think about 2 to 3 next year. So in other words, I would say that the market is anticipating this, and I think equity markets have also taken it in their stride. So even, there's caused some volatility in the growth technology stocks, but the thing is that I think this is not very surprising. So overall, yes, we continue to favor real risky assets, and we would be underweight fixed income. I would say that at the current juncture, we have to get yields, 10-year yields, for example, to get a little bit above, say, 2%. At that point, where we find that the risk premium attached to fixed income is a little bit more attractive, then we will want to neutralize our underweight in duration. But overall, I would say that actually, for investors, I think there are 2 things to note. Fixed income does play a part in your portfolio because they buffer your portfolio when there's risk-off scenarios. So certainly, risk-free rates would fall if there's ever like a growth scare, which we did see recently in December. That's one. 2, just to watch in terms of the interest rate, in terms of what's driving the interest rate hike. So long as it is growth still is good and strong, and not because growth is faltering and inflation is picking up, investors should certainly stay invested.
Right. Thank you. What about Pang Chi? What's your view on bonds? And very interesting question I also have is Fed has always want to be ahead of the curve. They've always given signals that they're ahead of the curve, but most of the time, if we look back, say the last 10, 15, 20 years, they're actually quite behind the curve. What's your take this round? Are they ahead, behind, or?
Yeah, that's an interesting question, right? I think, based on my very own observations, I think we've evolved from the time where US would say, we would do whatever it takes to achieve X, Y, Z, right? Today, you hear a slightly different rhetoric. It's a bit more nuanced, and they will probably say that by this date, we would like to be whatever, right? We would like to be, but we would like base rates to be this, we would like, employment to be this. So it's a bit more of a target-driven communication rather than, we're going to do whatever it takes to reach this, which was ironically quite well received by markets back then, right? If you recall. So I think what this means is that wanting to be ahead of the curve is one thing, right? But being able to put the right, policies in place based on where your economy is realistically, right? And we have to understand that globally, because of the pandemic and because of all these, accommodative policies, loose monetary policies that we've seen in the last couple of years, it's going to take a while for all these central banks to start, sort of pulling back, right? So the statement about time frame, I think, is a very, very apt one, because likewise in fixed income, it's very intuitive for people to say, oh, because base rates are going to go up, countries are going to hike rates, and therefore it's going to be a bad year for fixed income. I think it's very, it's too broad a statement, to sort of think that way, right? So I think we got to grapple with two things, right? First of all, one thing is how would governments actually roll out their policies based on each and every delicate scenario. And I say delicate scenario because most of the economies out there are trying to recover from the pandemic. And they've been doing so on accommodative policies, they've been doing so on monetary support that most of their governments or central banks have been giving them, right? So to say that we would like to raise rates by 3 times or whatsoever, it's good statements to make, but the reality is if the economy goes into shock for whatever reason, then as a market practitioner, as a market spectator, right, you can almost rest assured that there'll be some intervention involved. I think that's the common rhetoric we've seen over the last couple of years where fixed income is concerned, right? Then I would also point out a second point to say that within the fixed income spectrum, there are actually pockets of very attractive value. And I say this because if you look at how, let's say, Asian bonds have done over the course of last year, right? We saw accommodative policies, we saw general optimism, we saw some COVID recovery in China. So all the fundamentals seem to be in a right place, right? But Asian bonds underperformed, right? High yield, right? There was noise from property sectors and stuff like that, underperformed, right? But if you look at where they are now compared to the developed market parts of the world, right? Developed market investment grade, developed market high yield, you will see that Asia investment grade or Asian high yield in a sense, right, gives you, number one, a much more attractive yield, right? You're talking about 8+%, right? As compared to developed market high yield, which is there about 5-ish, 6%. You would also see that the default tendencies in Asia is extremely low as well, estimated to be at just at about 1%, right? So that's conducive generally for the high yield space. And last but not least, duration. I mean, when we talk about fixed income, it's either sort of credit risk or duration risk, right? And clearly, on the rate hiking path that we think we will be seeing, once again, in the slightly longer term, in our view, right, is that you want to stay away from longer duration. Now, coincidentally, Asian high yield is a short duration space, right, at about 3 and under years type of duration. And even Asia IG itself, right, I mean, it's a little bit further out, but if you look at the kind of yield it's giving you, right, like 4+%, as compared to developed market high yield, which is giving you like 2% and a bit more, right? You would see that in terms of yield pickup, in terms of credit fundamentals, in terms of duration, right? It's I would arguably say that Asia credits is in a sweet spot.
Thank you. Yes, please.
And if I could just jump in on this question, whether the Fed was behind the curve, I would actually say that market perception last year they did think that they were behind the curve. And for the reasons, they were using the old playbook from the global financial crisis. They wanted to they have their average inflation targeting framework that they had. So I would say for most of last year, the perception was that they were behind the curve. But I would say that in the last quarter of last year, in November, December, I think finally the Fed has caught on that inflation is no longer as transitory as what they think or as what they kind of communicated, and therefore they have pivoted and has changed the path forward from here. And I think the key takeaway from here is that it's good. So while there's a liquidity being withdrawn, it's actually better to reduce the risk to longer-term growth. And I think that's good for investors to stay invested in risky real assets.
Right. Thank you. And we've got a little bit more time. I just want to sum up a couple of points. One of the points that we talk about in this second round regarding interest rate is we all talk about when you invest, what exactly is your duration, right? So I just want to post it to everyone here, starting with Lim Yin. If you've got 1 minute to tell us where you're going to put your next 10,000 and how long are you looking at?
Any assets?
Well, it's up to you to tell us.
I think will be Chinese stocks.
Chinese stocks. And you think the turnaround will be 6, 12?
My time frame will be 12 months.
12 months. What about Pang Xi?
I will put them in Asian credits.
Asian credits.
Yeah, because having observed them over the last 12 months, compared to the overall, general dynamic in global fixed income,
Okay.
right? It's slowly but surely emerging as an attractive spot in fixed income, and the yield is something that I think I wouldn't shy away from. Yeah, and I would argue lastly that in a year like 2022, where you would see quite a fair bit of market choppiness, I would imagine, right? Yield could arguably be a very important part of your returns.
Okay. Clement?
Being the tech panelist here, I would say I'll go 50-50. So 50% in electric vehicles, obviously, because of that 1.4 billion replacement opportunity, and the other 50% in the metaverse. And it's a very natural hedge against EVs, because if you are fully immersed in the metaverse and you're sitting on your couch the whole day in your virtual 3D world, then maybe the demand for electric vehicles will fall. So I'm going 50-50. 50% electric vehicles, 50% metaverse. And my time frame is over the next 20 years.
20 years. Okay. What about you, Tujian?
Sure. I'm from the macro strategy perspective, so from the multi-asset. So I like to have as many engines firing as possible. So therefore, back to again, I would like to be invested in commodities, value equities. This will also be financials, actually, that'll be one part of it. Growth equities, again, that because the margins are high and it should still remain that way. And the other part, I think, would be real assets, because real assets are somewhat diversified from the risky assets, and that would be the real estate bucket, REITs, and as well as infrastructure. Because I think these are the ones that will still hold up. They will still benefit from the inelastic demand, the monopolistic business that they're in. So I think that will do well. So basically, even if the beta to market is low, actually the returns can be the same, if not higher. So that's the great, right? So that's engines all firing for the investor.
That's a good strategy too, right? Well, thank you everyone, and thank you our panels. They have obviously shared very valuable insights with us. I certainly hope it'll help you with your investment journey in 2022. Otherwise, I'm very appreciative of our panelists joining us here today. Thank you very much.
Thanks for having us.
Thank you.
Thanks.
Thank you.
Wow, very insightful indeed. Thank you so much, Henry, and the rest of the panelists. Now, moving on back to you guys, the audience. Okay, if you got any questions at any point in time, feel free to just comment it below. But now, very quickly, I'm going to give away some Tiger coins, okay, for our live online audience, whether you're on YouTube or on the Tiger app, okay? But for those on YouTube, right, you have to download the Tiger app, okay, if you want to win all these coins, okay? So very quickly, we're going to do a simple exercise for those of you that are joining us for the first time. Welcome to WWTD 2022. That is, what would Tiger do 2022, brought to you by Tiger Brokers. Okay, now, as I've mentioned, WWTD, 4 letters, okay? The first 5 in the comment section that writes down WWTD will walk away with some Tiger coins, okay? So very quickly, just comment down on the YouTube or especially the Tiger app, okay? All right, now very quickly, I'm going to share with you what's happening over at our experience store. Remember, it's not all work, it's play as well. So very quickly here, It's happening at Tiong Bahru, Yong Siak Street, 9 a.m. to 8 p.m. today and tomorrow, okay? And here's what's happening, okay? All right. Let's just wait for it to come on. That's right, we got the claw machine at our experience store. But what will you get when you manage to get it up here? Okay, the prizes are, okay, commission-free voucher, okay, $50 to $100 stock vouchers. We've got 888 Tiger coins because this year is the year of the Tiger and Chinese New Year is early for us, okay? We've got limited edition Tiger Brokers merchandise, and last but not least, we've got the Apple AirTag, okay? Okay, and we've got some participating outlets, okay? I heard there's free coffee over at Drips Bakery Cafe. We've got Chapter 55. We've got Old Shifu Charcoal Porridge, and last but not least, Tien's. Okay, so as you're going about our experience store and the cafe hopping nearby, okay, do remember to look out for our Tiger doors, okay, because you can get an extra chance at the claw machine and you can walk away with the awesome prizes I shared with you early on. But not to worry, for those of you that are not driving, okay, the eco-friendly, a lot of you, okay, 9 a.m. to 7 p.m., there are shuttles, bus services for all of you and your loved ones. So come on down. It's at 30 minutes interval, okay, at Tiong Bahru Plaza. This is where it is. Just take a good look at it. Screenshot. Okay. All right. And without further ado, what we're going to do now is we're going to let you watch a video. Okay, so feast your eyes on your very first course of what's happening actually at the experience store and what's in store for you there. Now, welcome back. Now, as many of you have heard our panel discussion earlier, we talked about 2021, okay, and what was in the past. Now, we're going to move on to what will happen in the future, particularly on the topic, will the good days continue for us here in our little island state, Singapore? So, without further ado, please put your thumbs up, like button as we welcome on set right now, Lo Su Fang, Vice President, Asia Equities Team, UOB AM. Welcome. Okay, now very quickly as we speak about today's topic, especially the theme about the geographical outlook in 2022, will the good days continue given that COVID has restricted us in one way or another, you know, with the heightened alert, we've got circuit breaker as well. You know, our GDP still stood at 7.2%. Now, here's the thing. Do you think we will see such growth in 2022 this year?
Well, we believe the reopening in Singapore is inevitable. 2022 would be a year where the pandemic recovery actually broadens and inflationary pressures actually stay persistent. As an export-oriented economy, Singapore is actually in a very good position to benefit from the regional growth momentum as the Southeast Asia's recovery actually gain more traction. Manufacturing and trade should stay resilient given that external demand is still very much robust. Singapore government's drive to actually re-establish the country as an aviation and financial hub would also give the customer service facing sector a much needed revival. And domestically, if we look at our vaccination rates, along with the steady rollout of COVID booster shots, that should actually facilitate the progressive easing of the domestic restrictions in Singapore itself. And even as we may experience intermittent retightening of some of the social curbs, we do think that once there is better clarity in terms of the effectiveness of the current vaccines against Omicron variant, we see the easing in restrictions, and that should actually help the economy. So adding on to the resurgence in infections, which is ongoing globally, some of the downside risks includes the supply chain bottlenecks as well as disruption. The other thing to watch out for is inflationary risk, given that Singapore is actually an economy which is highly reliant on imports. So if, given all these headwinds, we actually expect Singapore's GDP growth to actually see continued growth this year in 2022, but at a slower rebound of 3 to 5%, which we believe is achievable.
Okay, so Su Fang, you mentioned inflationary risk, okay? And inflation seems to be the buzzword for last year and this year as well. So what are your thoughts on this for our island state, Singapore, with regards to inflation?
Yes, I think the key risk ahead is inflation, of which a lot of economists actually expect it to moderate.
Yeah.
But the catch is that if inflation does not ease as fast as expected, then we may run into the risk of central banks actually aggressively hiking interest rates just to stay ahead of the curve. What market fears most at this point is that rising interest rates would actually stifle economic growth, and that actually leads to a stagflation, which is essentially characterized by high levels of inflation but low levels of growth. I would say that higher interest rates may not be bad for the Singapore market, but rising bond yields, along with big volatility in the bond markets, could be disruptive to the equity markets. Higher interest rates has an impact on asset values, and that could actually sway investment outflows from the capital markets. If you look at what's happening here, the MAS has actually forecasted core inflation to actually rise by 1 to 2% for 2022, which is a marginal rise compared to the 0.9% that we've seen in 2021. So what's driving prices is actually your higher import costs for one, the improving labor market conditions, the stronger private consumption that we are expected to see, especially for the rest of the year, as well as the domestic recovery in the overall economy. So I think at the end of the day, as long as there is a balance between economic growth and policy risks, we think inflation levels in Singapore should remain manageable.
Okay, thank you for that very comprehensive explanation. Now, you mentioned earlier MTI is estimated slower growth this year, right, Su Fang? Okay, are we going to see the same for the equities market in Singapore too? What are your thoughts?
Well, if you look at MTI's GDP growth forecast of 3 to 5% for 2022, while it is a moderation as compared to the advanced estimates of about 7% for 2021, it is a moderation, but do bear in mind, if we look at the midpoint of the forecast, it is still above the pre-COVID trend levels of 4.2%. I would also add that the current backdrop of rising interest rates environment is actually positive for the Singapore market. If you look at the Singapore market's domestic correlation to inflation and interest rate expectations, it is one of the highest in the Asia region. And if you look at the Singapore equities market itself, they do tend to outperform in a rising rate environment thanks to its heavier weighting towards the financial sectors. To give you an example, banks itself actually account for more than 40% of both the MSCI as well as the FTSE STI index. And given that banks' earnings are actually boosted by higher rates, they do tend to outperform in this rising rate environment. So as such, we do think that the broader Singapore market index itself could be very well supported by the rising rate expectations. Now, the current market is actually forecasting earnings growth for corporates to grow by 14% for 2022. And we think this is achievable and reasonable given that Singapore is actually steadily reopening its economy, as well as the shift to actually reopen the borders should allow for the broader economy to actually pick up momentum. So what's driving growth for this year will largely be your banks, which will continue to be the dominant driver, while other sectors such as your real estate, your transportation, as well as your communications sectors will continue to play a bigger role.
Okay. Now, we want to just ask about the threat of COVID-19. Now, we have seen the Delta variant, and of course, now we also are also having the Omicron as well. What are the impacts of this variant, especially the Omicron, and in future, if there are any others that were to surface as well, what is the impact on Singapore?
Yes, that's a good question. I think Omicron variant is at the top of most people's minds these days. At present, we see limited downside risk to the GDP growth forecast of 3 to 5% for 2022. Even though the Omicron variant is far more infectious, studies in many countries around the world confirm the view that the variant itself is less severe. And in Singapore itself, in view of the spike in cases, the government has actually come out to say that there will be no easing in the economy at least until after Chinese New Year in February, and added that we may actually see additional curbs to social restrictions if the transmission is actually amplified by unnecessary risks. So our view is that the economic impact from Omicron variant, as well as the subsequent waves of infections, should become smaller than before. There are a couple of reasons for this. Firstly, we think the economic impact and sensitivity to daily infections should be lower. If you look at the sensitivity of economic activities compared to mobility levels, it has declined drastically. And this is largely thanks in part due to the adoption of e-commerce as well as business continuity plans. A lot of corporates have actually tweaked or adapted to a post-COVID world to actually benefit from a different change of environment. Secondly, the shift towards hospitalization cases and severe cases imply a higher hurdle for a broad-based restrictions. And additionally, we think that the borders reopening is actually delayed but not derailed. Border restrictions could actually slow down the spread of Omicron, and it's most useful before the virus has actually entered the country. But once the virus has actually penetrated the borders, the trade-offs of actually keeping borders closed is actually much higher, especially for economies which is partly reliant on tourism and foreign workers such as Singapore. I think the coming few weeks would be key to watch. Market is likely to keep a close watch and reassess the economic impact as the local Omicron wave unfolds. And in the less likely scenario where the Omicron variant actually has a greater than expected impact on the economy, we do expect a fiscal response, especially towards those worst affected sectors, like what we have seen in the last 2 years.
Thanks for that. Now, I just want to ask you a personal question. For yourself, when COVID impacted your life, what were some of your fears, and how do you overcome it? So you can share with our audience online, maybe your personal story on how you overcame those fears. You mentioned quite a bit of things with us today about the outlook for Singapore and will the good days continue. But for yourself, with that question, how did you overcome that, or how do you find that hope in a sense?
Well, the travel bug in me would actually tell my younger self, actually travel more frequently.
Travel more frequently.
Yeah, that's one thing I really miss. That aside, it's just the simple things to actually spend more quality time with your family and loved ones.
Okay.
That is at the top of most of people's minds as well, I believe. Yeah. But what the pandemic has taught me is that, just to appreciate the simple things in life.
Don't take things for granted.
Yeah, exactly.
I hear you. Okay. But what about for your personal investments, equities, and whatever that you're involved in? I'm sure there must be something that you are apprehensive about, and how do you overcome that?
I think if we look back at the past 2 years, COVID has certainly created a lot of market volatility.
Yes.
Has impacted a lot of investment objectives as well as reasoning. What we have seen is that investors are a little bit, at any start of negative developments, there is always this fear and crowd mentality, which can move either way.
Yes.
I think the thing to keep in mind is to stay rational.
Yes.
Sometimes we just have to take a little step back, look at things from a broader perspective,
Yes.
And then look forward, in the longer term. I think that should help.
Okay. So I hear you. It's don't take things for granted, and also be very aware on the steps you're about to take also in the forecast ahead, right?
Yes. I mean, this is partly reflected in, we've seen sharp volatility in the markets.
Yeah.
And this is partly due to the knee-jerk reactions of most of investors, which is understandable because it's part of our human nature.
Yeah. It can definitely go both ways, like you mentioned.
Absolutely.
And COVID has definitely taught us to be ever adaptive to change. Now, I think there's a question from online, okay? So, Su Fang, if you don't mind, let me just read out the question online from one of our audience. And the question is, REITs a good income solution for 2022? Okay, that's very in tune with actually the next question we actually have for you. It's Singaporeans' favorite asset class, yet it underperformed global peers. Okay, so will this trend continue? And what is the outlook for S-REITs for 2022 here in Singapore?
That's a good question. If you look at S-REITs, it has actually underperformed in first half of 2021, though we did see a bit of a bounce back in second half. But as you correctly pointed out, S-REITs as a whole has underperformed global peers, especially those US-listed REITs. And there are a couple of reasons for this. First of all, we have a stricter mobility restrictions in Singapore. Secondly, the ASEAN's vaccination rate has actually lagged in relative terms to other countries such as your UK or US. But if we take a step back and look at 2020, S-REITs actually outperformed and it posted stellar returns. And this is actually partly due to the fact that its status as a defensive and reliable investment asset class. And we have seen that being resulting in good performance in the face of uncertainties during the pandemic. So as for 2021, aside from the lack of mobility, S-REIT's performance was also hampered by concerns over rising interest rates, which have implications across various sectors. REITs, for one, as a defensive asset class, will be deemed less attractive given its dividend yield. And as such, we actually saw bouts of rotation away from defensive sectors like your REITs, your telcos, towards the more cyclically driven in sectors like your financials and industrials. That's one. And secondly, we also see that REITs was a common funding source for most MSCI-based asset managers as they actually incorporate the higher weighting of C Limited. So these were the key drags which actually weigh on the sector performance pretty much of last year. So if we look forward to 2022,
outlook for 2022.
Yeah, and for the rest of this year, we expect the sector to remain challenging. Well, it is intuitive to actually dismiss S-REITs in the face of rising interest rates. Past precedents actually strongly suggest that S-REITs actually perform well typically in a rising rates if they are accompanied by positive dividend or DPU growth.
Yeah.
So for this year itself, for 2022, we expect the DPU to actually grow by about 6.8% on average. And we believe this is achievable, and bear in mind that this is still above the pre-COVID trends of about 5%.
Oh.
Most of this growth would be driven by the abatement in rental waivers and improving office rental outlook, as well as growth from acquisitions. And just to give you a bit more color from a sectorial perspective.
Yeah, we appreciate that.
Yeah, I mean, we expect industrial S-REITs to continue to outperform. They should remain resilient given the tight demand and supply. Retail S-REITs, for example, should see better trading conditions once social mobility actually picks up, especially in the second half of this year. If you look at office S-REITs itself, the outlook is a little bit mixed. We do see a bit of a diverging trends within the sector, and there's signs of flight to quality in some markets. So as such, we think that landlords with quality assets in premium locations should continue to outperform. And moving on to hospitality S-REITs, we think that REITs would actually see continued recovery in earnings, but this will be driven mainly by the pivot towards new business models such as your student accommodation or your government isolation business. And this is partly due to the fact that there is still a lack of a meaningful rebound in tourist arrivals. So all in, the robust DPU growth for S-REITs for 2022 should translate to an attractive dividend yield of about 5.2%, which compares very well against your other dividend plays like your banks or your telcos. So we think this should actually support the sector valuation as well going forward.
Very, very interesting that you pointed out that it is performing even better than pre-COVID days. Huh? Now, but a very quick question just off the cuff here is that the outlook for S-REITs in the year ahead, will it also, what's your hunch? Will it be better than the global performance throughout? Because last year it wasn't. So but what about this year? Just your hunch. Yes. I know I'm throwing this at you.
Yeah, that's an interesting question because if you look at the valuations for S-REITs as compared to the global peers or APAC peers, it is cheap by all means on relative basis and absolute basis. And it has been a laggard in 2021. So we do expect, some of these, valuation to actually see a re-rating, given that, Singapore is actually now in a more advanced stage towards reopening sustainably as compared to the other peers.
Yes, I hear you.
And if you look at the valuation for S-REITs itself, we're still trading at mean level on a yield spread basis. So I think there is certainly value there and there's attraction. And we do see that, the sector would become more interesting in 2022, given that we have a couple of big mergers which is evolving now as we speak. There is also the impending listing of possibly a couple of exciting S-REITs with different asset classes. That would actually add more depth and excite the market. And hopefully investors will actually warm up again to the S-REITs. But having said that, even though this sector is, you may actually turn favorable on and off, one has to keep in mind, that S-REITs is a defensive asset class, and it is a good play if you want passive income in terms of the dividend yield. And if you look at the dividend yield, it is still very much attractive.
Yeah, thank you so much for that. Now, just now we talked about the Omicron variant and how the possibility for tightening of borders. Now, on that note, right, tying it to tourism, okay, another question from the audience here we see live is that, will restricted tourism affect REITs' value?
Yes, if you look at the overall projections for the S-REITs itself, at the moment, the expectations are not lofty. The market is expecting, almost a status quo and possibly a little bit of improvement in terms of tourist arrivals, maybe in the second half of this year, provided that the government actually relaxes the border restrictions further.
Yeah.
And we believe that the government's objective to reopen is still very much intact. As I said, we think that the borders reopening has been delayed but not derailed.
Yes.
So in that sense, if you take a longer term outlook, we do expect the REITs to actually recover or re-rate upwards as we see more convincing numbers in terms of the earnings. Hospitality REITs, for example, even though there is a lack of a meaningful rebound in tourist arrivals into Singapore, they have actually managed to tide through this period, given that most of these REITs actually have a strong buffer given the master leases which are protected.
Yeah.
So in this way, they actually receive a minimum level of income, regardless of whether the business is actually doing fairly well or too bad. So in this sense, they are still fairly resilient. And if you look at the valuations for hospitality as REITs, it is still cheap, and we certainly see some value in there.
Yeah. What about the retail portion of it as REITs?
As the retail as REITs, we think
because retail is tied to tourism in a sense, and that would be the impact where its value stands, right? Because it's correlated. So will its value increase or decrease?
That's a good question. Retail as REITs has, in our opinion, represents value. We see pockets of opportunities. As you know, the COVID has resulted in a lot of changes structurally. REITs is wasn't spared from that. Retail REITs has always been impacted by the structural growth of e-commerce, and we did see that this trend was exacerbated during the COVID period. A lot of the retail REITs have actually adapted in a way by incorporating a lot more of use of technology, and that should actually help to reposition themselves. For retail REITs, the key is obviously increase in social mobility, especially when more workers return to the office. More foot traffic would actually boost retail sales. But interestingly, if you look at the retail sales itself, retail sales has recovered much higher than the recovery in foot traffic for most of the retail malls. So that tells you that, regardless of whether you have increased mobility or more foot traffic, retail sales has recovered and will continue to recover. In terms of the asset values for retail properties itself, in Singapore, we are quite fortunate because there is a limited supply over here. So in a way that has actually protected or make the property values more resilient. We did not see drastic devaluation in terms of the physical properties itself during the pandemic, unlike other countries which have seen a massive devaluation.
Yes.
Similarly, we think the limited supply of retail shopping malls in Singapore itself should allow for the continued recovery in the rental rates. And as we speak, the rental rates for retail REITs has more or less bottomed or continue to narrow in terms of its decline. And we think that it should actually turn positive or be flat for 2022. If you look at the yields of retail REITs itself, it is much higher compared to your industrial REITs, given that the latter is actually has performed well, so valuation is a little bit more expensive. So there's a lot of value in retail REITs itself.
Yeah, that's very interesting. Thank you for that insightful sharing of all the different REITs. And what I hear from you, and I'm sure the audience as well can hear, is that the resilience is there from not just REITs itself, but I'm guessing the people. When you talked about retail, you said people are taking it online, the e-commerce and everything. I think that's how REITs, in a sense, the value, especially for retail portion, is is still, in a sense, on the upward trend, like you mentioned earlier. And I think that's one of the highlight and the beautiful thing, even though COVID has definitely changed the lives of many of us here in Singapore as well as around the region and the world, but it has also definitely brought out goodness and good values and resilience in that sense amongst us people. So very quickly, we've done with the questions from the audience as well. Now, before we end things here with Su Fang, we want to thank you for your time, but before we end, any last words you want to share with the audience back home about whatever we have talked about? Will the good days last here in Singapore? Any last words for all of us?
Yes, I think the key here is to always stay invested. It's a bit hard to actually play the timing factor, as most of us would probably or personally experience. You try to time it and then you get, you miss the opportunity. That's the worst feeling. An investor would, right? An investor would ever want to have, right? So I think the key here is to be selective. Have be very objective in your investment outlook. As well as your purpose and goals. And I think, for Singapore itself, we are not going to see like super duper exciting, sexy growth, but it will still grow. And that's key for most investors investing in the local market here.
Okay. Wow, thank you so much. I think we've come to the end of our time here, speaking about Singapore, and will the good days continue for our Geographical Outlook 2022. We're going to move on to another topic very shortly. But before I do so, just a quick shout out to the audience, okay? The first 3 of you that actually types down REITs, all right? Spell it out, will walk away with Tiger coins, okay? You heard me, okay? The first 3 of you that actually writes down REITs, okay, in the comment section on our Tiger app, okay? So for those of you on YouTube, once again, download the Tiger app, head on there, and you can earn Tiger coins for yourself, okay? And begin this journey if you have not already, okay? And very quickly, once again, the first 3 that types down REITs, okay, will walk away with Tiger coins. I will share with you the value later on, okay, in a moment's time. But for now, we're going to move on to another part of the world. We're going to be talking about China, between attraction and avoidance, with one of the earlier panelists, Lim Pang Chi. All right, welcome back. As you can see in the hot seat, we have with me Lim Pang Chi, Head of Singapore Retail Fidelity International. Welcome, Pang Chi.
Thank you for having me.
Welcome back again. Now, we're going to pick your brains a little bit more here in this session. But very quickly, we're going to be talking about China, between attraction and avoidance. So very, very quick question here is, we're going to start off with, how would you summarize the outlook for China in a few sentences?
Sure. shorter is always tougher, right? Yes. And I would say that let's look at China over the last 1 or 2 years and developments that we've seen in general. But I think through the onset of the dynamic, China came out very strongly. It was all over the headlines. They did well and had positive GDP in a year where, I would say many other countries in the world were going the other direction, right? So I think they've done well in that regard. Going into 2021, we saw some developments. We read some headlines around the likes of technology, education, and I guess in more recent months, Chinese property as well, right? And then there were talks. I was in an earlier panel speaking about various things in the macroeconomy, and terms like China, common prosperity came up and things like that. So these are all headlines that we feel are going to be integral to China's future.
Yes.
And I guess capping that off, the key message I want to sort of put in before we dive into the deeper conversation is that we need to understand two things from here, right? The headlines and the developments we saw, this year and slightly before that. How do we understand some of these developments? And more importantly, how do we appreciate some of these longer-term structural opportunities in China? I think that will allow our investors, our audience, to maybe appreciate this market a bit better, to understand what are the challenges or what are the opportunities, short-term and long-term beyond.
Yes, I think that's very key for people to first understand. And when you understand something, you can appreciate it.
Exactly.
So we hear you loud and clear. Thank you for that. Now, okay, very quickly now we go on to the next question then, Pangqi, would be, how can investors look to navigate China? Is it investable? That's the question. But
Sure.
maybe you can first talk about how we can understand it, and then we can appreciate it. Then, can we invest? Is it investable?
The million-dollar question.
Yes.
Yep. Absolutely. Let me just come into my slides. So I would largely say that if you think about the navigating or investors navigating themselves across China, we got to look at two investable trends, right? And the first one here is on consumption. I think the word consumption is extremely important because it encapsulates what we mentioned earlier about common prosperity, which is the whole idea behind narrowing wealth gaps in China, in making sure that it's not a polarized, eventual developed economy whereby you've got 5% of ultra-rich and the rest of the population is lagging far behind, right? I think that's one thing that clearly, China's trying to move towards too, right? And what this means is that it needs to drive, people's wages. It needs to drive people's consumption habits. They need the general masses to understand that it is more important to be able to, aspire, right, to protect yourselves, buy insurance, buy better pairs of shoes as you move out from tier 4, tier 3 cities. They need to see that part of consumption come alive and improve. And that's where you can see, right, on the chart right here, that the consumption growth effectively over the last 20 years has been, quite phenomenal, right? You'd see from the chart here, China, 2009, it was, till 2019, and most importantly, the aspiration of 2030 itself, right? And likewise, if you look at disposable income on the right-hand side, right, I think China per capita disposable income
it's the highest,
has gone up.
To say.
And it's still not as high as it should be, right? One would argue. So if you compare that to developed market opportunities, exactly, potential, right? So you would see that comparing this with US per capita, Europe per capita, it already is on the high side in terms of growth, but one would argue that there is a lot more room to go.
Yes.
Yeah.
A lot more room, and the difference is quite a margin.
Absolutely.
So we hear from you is consumption, and we understand it a little bit better now, the China market, and we can be then a little bit more appreciative. So the what you mentioned is, in a sense, it's investable.
For sure.
It is.
For sure. For sure.
Just putting out there to our audience, because I understand that some of our audience are as young as 25 years old. Yeah?
I was 25 once.
That's when you... well, how early do you start investing?
I would say I started investing in my uni days.
So
I was actually before I was 25.
Before you're 25?
Yeah, before I was 25.
Wow, interesting.
No, but those were very small investments, right? But I look at some of how, and I'll be very open and transparent, right? I mean,
sure, we love that.
I was buying, plans. I was putting in $100 a month, that kind of thing that a typical undergraduate, I guess, could try and afford, right?
Yeah.
And these things grow through 2008, and you would see that a couple of $100 became, $2,000-$3,000, right? Over. But of course, it was a very bad wave in 2008. We all know that, right? And the subsequent recovery in 2009 was, once again phenomenal, right? So I caught that wave, and just now when I was sitting here listening to one of the other speakers who spoke about stay invested, right? I can't agree more, actually.
Yeah.
I think in a world where things are constantly moving, right? And we need to always ensure that that we, or rather, I would say that we cannot be constantly putting ourselves in a position where we miss all these waves.
Yes.
And who would catch all these timings? No one, right, could catch them 100% accurately.
Yeah.
Right. So I think the whole idea is to make measured judgments.
Yes.
To make informed decisions.
Yes.
Right, and stick through the wave. I think that's what I would say.
I think that's a general theme. The earlier speaker said as well, to really weigh your costs, but don't miss the boat in a sense, or don't just there's a saying, a ship is not meant to be docked at the harbor, right? and we hear you loud and clear. So just a quick shout out to our audience online. We understand that some of you are really young undergrads, or even going through uni or even poly, wherever you are. Wherever in the world as well, investing is never too early to start, right? It's just like learning how to ride a bike or learning to surf, right? Yeah, we all begin that journey somewhere. Okay, let's move on to the next one, shall we?
Yeah.
Question. Okay.
Actually, if you pardon me, I actually wanted to speak a little bit more on the next slide, right?
Okay.
Let's show the slides back, and I just wanted to move on a little bit more from consumption and volatile and income into the next slide, where we look at sort of investments in technology and digitization.
Okay.
So your question earlier about I realized I should have shown this when you were asking, is it investable, right?
You're too excited.
Yeah.
We just look at the numbers and then we just it looks good. Let's go.
Right. Well, but there is a lot of structural opportunity behind what we can actually potentially put money in, right? Yes. And you'd see here, right, that in China, there's been a lot of intentions in terms of wanting to invest in the area of technology and digitalization, right? I mean, back in, when I was a kid or when I was growing up, right, we had a lot of goods that we buy here in Singapore that were made in China, right? Yes. Made in China, shoes, clothes, and a lot of it, right? And today you see less of it, right? I mean, if you did go into a fashion store or whatsoever, chances are it's probably not made there, right? And the reason for this is because I think the market is moving towards digitalization and a different kind of economy, right? And you'd see that aspirations, for 2025, which isn't very far away, right, is that it needs to be in the direction of building smart cities, using AI to basically, lessen carbon emissions. And corporates are all on board, right? So we spoke about things like common prosperity earlier, right?
Yes.
We have companies like Tencent, who's come out to pledge that they will contribute. They Chinese call it the third distribution outside of taxes and sort of income, right? Yeah. A third distribution which talks about corporates coming back to socially help the society as well, and a company like Tencent, as I've read, is pledging, the equivalent of 15 billion US dollars to sort of plow that back into society. So it shows you that there are many parts of this economy that is clicking together. Yeah. It could take time, and you'd see a landmark here, right, which is 2025, where whether you talk about internet services, 5G networks, big data centers, artificial intelligence, which I spoke about. These will all play a massive role, right? In terms of, I wouldn't call it reinventing the economy, but I think it's a very healthy, evolving, stage which I think investors in this space should appreciate.
Yeah, and we hear you loud and clear. I think the idea is that just as we have grown up from our younger selves when you were investing $100 a month during uni days, now I'm guessing the price is different too for your investment.
Absolutely.
So same thing for them. A very interesting point you pointed out earlier about how things in your younger years were all made in China, especially when you talk about retail, but now it's changing indeed towards digitalization. On that note, just want to ask you, for fixed income investors in China, do we still see opportunities for them as well?
Sure.
Yeah.
Sure. Let me, again, refer back to one or two of my slides.
Sure. At the end of the day, all this is really for our audience to share with them and to further put across our point here on China.
Absolutely.
Yeah.
Let's maybe start from the equity side, right? I think if you're talking about investability, clearly I think there's a lot to read about China markets, right? And this is basically a very quick valuation snapshot of Chinese stocks versus global markets, right? You've got different regions, you've got emerging markets, broad Asia, ex-Japan, Europe, US, and the rest of the world. And you would see that these are 10-year ranges, right? That's why you see that bar in blue. And that dot, that yellow dot you see in each of these charts is a point in time for August 2021. Now, what this tells you is that you would see that this is plotted against price to earnings ratio, or practitioners like ourselves, we often say PE ratio, right? So the lower the ratio it is, the cheaper it is, the better value it is, right? And likewise, the higher it is, the more expensive things are. Now, clearly, if you think about the backdrop I just gave you in the last two slides, right, in terms of longer-term structural growth, and even, I guess, in medium-term potential in 2025, the digital transformation we spoke about, then one would argue that behind some of the headlines we saw, whether it's property, technology, or even education, right, that potentially caused a bit of underperformance in China in 2021, you could potentially be in a pretty sweet spot to put some positions into China again, because
it is negligible in a sense.
Sorry, again?
These are small compared to the growth that they're having.
Oh, for sure.
Yeah.
For sure. I think if you're talking about the massive developments of longer term waves like rural-urban migration, common prosperity themes, which would see that whole big mess of Chinese consumers sort of move up that value chain.
From tier 4 cities to tier 3, like you're mentioning.
And granted that they are one of the most populated countries in the world. So if that part of the pie increases and grows, for every incremental dollar, you can imagine how much of an impact that will make to the economy.
Yeah,
just from a consumption perspective.
Yeah, and the growth is definitely there.
Absolutely.
Internal and external, and if the internal grows, all the more we'll benefit.
Absolutely right. Yep.
Yeah, I hear you.
So, sorry, let me just address your question as well on the fixed income side. So we spoke about equities again, very exciting, but let's look at Chinese fixed income, right? I think we saw some volatility in Chinese property. Yeah. But I want to use this chart to probably also help our audience to understand that regardless of what we read in the papers, right, there's one or two companies where they have issues paying up their bonds and stuff like that. We have to first and foremost understand that property is a huge cornerstone of the Chinese economy.
It is.
Right?
It is.
And with every economy out there, if you have a cornerstone sector, right, chances are you're not going to let it fail.
Yes.
Right? Just like Singapore, we wouldn't let our banks fail. I mean, it's something intuitive that I just want to paint to our audience, right?
It's one of the foundation pillars.
Exactly. So you would see from the chart on the left-hand side that it's a key contributing sector to China GDP, and that hasn't changed throughout the years, right? And most importantly, land-related activities and sales. It's the reason why a lot of the towns and cities in China are growing and proceeding the way they are. So we spoke about social mobility, we spoke about people moving from towns to bigger cities and so on and so forth. I think all these developments and all these social mobility initiatives you would see that that only comes as a result of things like land sales and how the local government deals with it and applies that to the betterment of their citizens, right? So you would see that the property sector is one where we might have heard a lot of noise on, but again, I think that there's massive opportunities in that space.
Definitely. And the trend is there.
Absolutely.
You can see the numbers don't lie. The graphs as well.
Yep. And to sort of address your questions, right, with regards to bonds, right? I think if we just look at the last slide that I was about to show before we
China market bonds,
exactly right. So I think Chinese bonds, you would see, right, on the left-hand side, we just take a common platform, right, in terms of 10-year government bond yields, right? You would see that the China bond yields are, I'll say relatively higher than the likes of developed markets, US, UK, and
close to 2 times actually for the next highest one,
And I really wanted to highlight in German bonds, for example, right, where you have negative yields, right?
Wow.
Which really puts you in a position where it doesn't make sense, right, to buy bonds like that. But more importantly, apart from where static bond yields are in a 10-year frame, let's look at the right-hand side, right, and you would see that we've also plotted 5-year Sharpe ratio. Now, Sharpe ratio basically means risk-adjusted returns, right? So for every dollar of risk you take, how much returns are you making out of that? And you would see in the orange portions below, whether you're slicing and dicing it into offshore renminbi bonds or onshore renminbi bonds. This is just places where you can buy some of these bonds and their denomination, right? Whether you're talking about them denominated in yuan, denominated in US dollars. These are all different mediums of which you can invest in Chinese bonds, right? And one would see in that chart below, comparing it to the blue portions, right? There is quite a bit of juice in Chinese bond markets, right? So to your question, short answer to your question is definitely investable, definitely opportunistic, right? And one that I cannot repeat enough, right? To have an allocation in your portfolio enough for you to experience, right, the yield, the potential upside that structural long-term developments can bring you, but at the same time, stay diversified in some other stuff, right? If we had panelists just now speaking about technology, myself, we spoke about healthcare a little bit. Diversify your bets. And in the realm of fixed income, particularly in Asia fixed income, we think Chinese bonds could be an area where people could be well served taking some positions in as well.
Yeah, indeed. There's a saying: don't keep your eggs in all one basket, right?
Absolutely right.
So we heard it from the man himself, Pang Xi. Okay, we are running out of time. But very quickly, just let me ask, do you invest in the China market, personally?
Yes, I do.
Okay.
Yes, I do.
Now, the next question is, when you first started, okay, what are some of the advice that your current self now would tell your younger self when you first started? Okay, so rewind yourself back to the days where you're like, and that feeling. Maybe you can share with us, the audience.
I read pretty much as a student. So I'm the kind who, before I go into something, I want to make sure that I've got maximum knowledge of it.
You want to understand it fully.
Yes. Okay. But I would say, there is just so much you can get from reading, right? Because a lot of that is in the news. A lot of it is probably things that are past us. I think what's important is to get exposure out there in the market. Events like this, right, will give you, I guess, market practitioner views. Right? I think that's a great value add. I didn't attend enough of these things. Maybe there weren't that many of these things, right, to start with when I was that age. And most importantly, be very open-minded, right? I think you would read in the papers and you would see in charts, right, a scorecard of how 2021 has been. Right? You'll say that, this market has been bad, this market has been good, what is red, what is green, right? And intuitively, in a behavioral sense, you tend to look at the red stuff and say, I don't want to be in debt because I don't want to lose 20%, right? But what you don't realize is that it's a continuum.
Okay, so what I hear from you, sorry for another thing, because we're really running tight on time.
Sure.
2 O's, opportunity and to seize the opportunity and always to be open.
For sure.
Yes. All right.
For sure. Yep.
Okay.
Absolutely.
Once again, for those of us online, let's help me thank our speaker right now, Lim Pang Chi, Head of Singapore Retail Fidelity International. Thank you so much for your time.
Thank you.
Now, don't go anywhere. Right now, we're going to shift our attention to what's happening right here for the webinar, WWTD 2022, okay? And once again, like I always say, it is not just all work, there's also play. So we're going to shift our attention now over to the experience store over at Tiong Bahru. That's right, you can see it on the slide here. It's at Yong Siak Street, 7 Yong Siak Street. It's happening today and tomorrow, okay? So if you want to head on down with you and your loved ones, okay, feel free to. Lots of prizes to give away, all right? And there's a claw machine there, all right? There's a claw machine there, and these are the prizes you can get from the claw machine, okay? There we go. We've got commission-free vouchers, $50 to $100 stock vouchers, 888 Tiger coins. That's right. Chinese New Year has come a little bit earlier this year. And this is the year of Tiger. So Tiger Brokers, we like to bless all of you. Okay, so head on there. Remember, you can get it from the claw machine, limited edition Tiger Brokers merchandise, and last but not least, Apple AirTag. Okay, and that's participating outlets are as follows. Okay, I heard there is free coffee being given away at Drips Bakery Coffee. We also got Old Shifu Charcoal Porridge, Tian's, and Chapter 55. Okay? And now, when you're going about all these stores, remember to look out for our Tiger dolls. That's right. Okay? And get another chance at the claw machine. Okay? Remember, so this weekend is all about you, our online audience, and if you feel the need, for those of you here in Singapore, feel free to head on down to Tiong Bahru, okay? And there's free shuttle service, okay, 9 a.m. to 7 p.m. Tiong Bahru Plaza, all right? And this is where it is, okay? You want to take a screenshot of that? Please do it, okay, very quickly before we move on to the next one. Yeah, okay. And if you're not sure what to buy, scan this QR code, you know, Unit Trust Starter Pack here at Tiger Brokers, exposure to global equity and global bonds. Get yours at $50 off today. If I'm not wrong, this is only available for this weekend, WWTD 2022. Now, for our online audience, okay, don't worry, I have not forgotten all of you, okay? Those of you that are not in Singapore, our friends in China, our friends all over the globe, okay? Vietnam, Philippines, Thailand, wherever you are, US, UK, you know, we've got you covered, okay? We're going to be giving away Tiger coins throughout this webinar, so you want to stay tuned for that. Okay, very quickly now, we're going to move on to our next segment, and our next segment is going to be talking about Asia and Asia Pacific. Volatility equals opportunity. So, feast your eyes on the Experience Store video in the meantime. That's right. Welcome back to our friends on YouTube as well as on our Tiger app. We've got with me Lim Yun, one of the panel speakers earlier. For those of you just joining us, he's the Chief Investment Strategist at Lion Global's Investors. Now, we're going to be talking about Asia and Asia Pacific. Volatility equals opportunity. Now, the word opportunity has been coming up over and over again. Now, so very quickly, I just started off with a quick question, okay? What are the risks of a major correction with withdrawal of liquidity and higher valuations in stock market, especially in the US?
I think, if you take a step back and you think about it, over the last 3 years, especially in the US, the stock market over there has done really well, right? And this is despite the fact that we actually have a period from 2019, end of it, all the way to 2021, and 2020, 2021, where there's this COVID, there's this lockdown, and a lot of the industries were actually devastated. But despite that, the equity markets actually continue to go up. And today, if you look at in the US, you look at Singapore, you look at a lot of places, hard assets, stocks, bonds, they all have done really well. So I think part of the reasons behind that could actually be because of the low interest rate environment and also because of this, should I say, excess liquidity that's entering into the system. So this could actually be in the form of the central banks actually buying bonds. So we call it QE or quantitative easing, or also the fiscal spending that the governments have put in place. So in Singapore's case, if you think about it, it would be your vouchers that the government gives, some of the subsidies that they give to the companies and so on and so forth. So in short, in 2022, I think there are some risks in the environment itself that will cause short-term volatility, and one of which is actually this tapering itself, which means that liquidity is being slowly withdrawn from the system itself. So which are the markets that have actually benefited the most from this injection of liquidity would be one of it, which is the US. Then the logical conclusion would be that it will be more challenging for such a market. But that said, we are actually positive on the long term, prospects of stocks itself. So later, I will actually introduce to you our views of 2022, the investment opportunities over there, and from there, you guys could actually. I'm not here to ask you guys to buy this or to buy that, but basically to discuss so that we can all make the right, so-called the informed right decisions itself. Yep.
That's right. And again, this is your professional opinion, and you are expert clearly in the industry. You spoke at length about US and how they're doing fantastic. But just go off tangent a little bit. Just speak about Singapore. How is Singapore in light of that for the liquidity and the higher valuations in the stock market?
We have done also well, I think to a certain extent. But I think there's still room for Singapore to go. One of which, I think there are a few things that are positive for the Singapore market. One, which is actually if you think about the Singapore so-called the Straits Times Index or the stock market itself, in Singapore actually there's a big enough or significant proportion of the stocks that are mostly old economy. So in a way, what we are talking about would be like, your financial stocks, right? Your banks, and why not? And actually a lot of it also depends on oil and gas. So there are some of the older economy stocks, there will be, properties and so on and so forth. In this 2022 outlook that we're going to introduce to you guys, we think that Singapore being an open economy will actually benefit in this post-COVID world, meaning that in this reopening where air travels comes back again, some of these old economy stocks will actually do well. And actually, we are also in the stage of an interest rate hike, and that would actually be positive for the financial stocks, which in this case would be the banking stocks. And likewise, commodity prices, we expect commodity prices to stay high. So that includes, the oil and gas sector, and that would actually be positive for that. So there's actually, a few major positives that are coming for the Singapore market. So we are actually quite positive on the Singapore market.
Okay, I hear you. Thank you so much, Lim Yin. Now, speaking about how things are returning to normal in the sense where if air traffic is open, borders are a little bit more lax, hopefully Omicron abates. And in light of that, would technology stocks globally, especially those that have benefited from COVID, I'm sure many of us have gone from live to look what we are doing today online, our meetings from in-person meetings to Zoom meetings. Will technology stocks continue to do well in a sense, what we call the post-COVID world?
I think when you talk about technology stocks, it's not a uniform thing, right?
Yes.
We just give a name to it and say everything umbrella and everything is actually a technology stock. But actually, I don't like the term. What I like to use is actually, should I say, disruptive stocks that are more important. Disruptive.
That's
so I think a lot of people will actually be very familiar with the term disruptive innovation, meaning that there's a new technology that comes out, a new way to do things, a new business model whereby the new players actually eats the lunch of the old players. So in this case, in a retail space, right? For example, you talk about the e-commerce, right? Yes. So e-commerce is the lunch of the mom and the brick and mortar shops that we have over here, right? So that could be one of them. If you talk about tech stocks, it actually also includes some of the old so-called old technology stocks, right? So those that maybe in the PC area, which is basically the mobile world is actually taking the lunch of these guys, right? Some of these, I'm not sure, but if you think about it, some of these stocks, these tech stocks could actually be doing the components, the parts that could actually be used in, let's say, a product that is going obsolete, right? So in this case, it could be, I think some of the panelists have actually mentioned electric vehicle. So some of these tech companies actually provide, the components and what have you, the software that's going to be used in, let's say, a so-called gasoline car. You call it ICE car, right? Internal combustion cars, right? Or what have you. So this will actually be disrupted by the electric vehicle, right? So in a way, if you look at technology as a whole, there will be winners and there will be losers. So actually, from my perspective, there will be this segment of tech stocks that actually have a very long runway because they are eating the lunches of all the other companies. They are disrupting the way business is being done, the way products are being sold. So in a way, it's difficult to have a so-called a generic statement to say that these tech stocks will actually do well or not do well. So that out of the way, another thing that you have to consider about is also the time frame.
Yes.
Okay.
I hear you.
So over the last 3 years, tech stocks have done really well globally, except for Chinese tech stocks, right? So the time frame.
Let me stop you there. If you don't mind, why is that so?
Okay, so basically it is this way, right? The Chinese tech stocks have also done really well, right? They have grown really well. Revenues are growing very well. But last year, the Chinese government has actually introduced new regulations, right? For example, for some of the platform companies, I think we will be more familiar with, let's say, Lazada.
Yes.
In Japan, you have the Rakutens of the world. In China, Taobao and what have you, right? So these are called platform companies. So whereby, you have a platform, merchants come in, have their goods over there, and they sell it. These companies have grown really big, right? And they have grown really big with minimum regulations because they started off small. And the governments all of the world actually wanted to encourage innovation. So they allow them to grow with minimum regulations. But it has reached a point whereby this is not only a China issue, but this is a global issue, whereby some of these companies could become monopolistic, right? Meaning that, for example, I have a campaign, I force my merchants to actually come out with a much bigger discount. This is forcing them, right? Or they could actually use their position to say that, if you list your products in my platform itself, you cannot list in somebody else. So these are so-called monopolistic kind of behavior.
In a sense, their hands are tied.
That's right. So governments of the world are thinking, right, in their mind, right, that we want to put a stop to this thing, right? So they are introducing new regulations to stop all this. So it could also be in the form of, let's say, the gig economy, right? So whereby you have the people who actually deliver food or what have you. these guys come without, let's say, should I say, social security, insurance or work compensation in case they get injured, or there's no minimum wages or what have you, right? So some of these things where in society we should have it in place for a normal society, but because of innovation, some of these regulations have not caught up.
Yeah.
So what I'm saying is that in China, because they are more efficient, right, and they are very fast, so last year they put in place various regulations in place to actually address this. So for market participants, what they are worried about is actually the uncertainty. Post uncertainty, if we know exactly where the rules are, then we can calculate, right, where the earnings, the margins will be, and based on the growth rate itself, what kind of valuations or the company should actually be worth. But with uncertainty, right, investors would actually de-risk first.
Yeah.
And they will monitor before they take action, right? So a lot of this money has gone from the Chinese tech stocks. If you are rebalancing it within the whole sector itself, then it could also go into, let's say, the Indian tech stocks.
Yes.
Could also go into the US tech stocks. Now here comes in, a bigger issue or bigger question that you have to ask. Does that mean that all the other global tech stocks would have no regulations going forward? Answer is probably not, right? It's only that, when you talk about certain other countries they actually have to take a longer period of time for some of these rules to be put in place. So case in point will be, if you want to put in place some antitrust laws, the lobbyists could actually, come in and say, hey, let's not do this thing, it's bad for innovation and what have you. So it will take time in the developed markets, in some of these markets, for some of these regulations to be passed through. But that said, over the next 1, 2, 3 years time frame, you could actually see increasing regulations also in some of the global tech sector itself. So what I'm saying is that, in the Chinese side, a lot of things have actually been front-loaded. They are very efficient, they know what they want, and they say, oh, these are the new regulations that should be put in place, and as such, they roll it out. So in short, I think once the regulations are in place, they know that, based on these, some of these so-called, should I say, not so great, characteristics like anti-monopoly, monopolistic kind of a behavior, albeit in terms of, let's say, the gig workers, you take care of them and what have you. Once these things are in place, then I guess there will be less new regulations that are put in, there'll be more certainty, and as such, subsequently, interest will go back into these sectors itself.
I hear you. So in a sense, with all this uncertainty, of course, you will de-risk. And then when the opportunity comes again,
it's basically, for fund managers, it's this, right? It's basically a so-called, you always balance, right?
Yeah.
You have $100, do you invest in this or do you invest in that, right? Or you do 50-50 or what have you, right? Yeah, so every time frame, every day we wake up, we take a look at our portfolio itself and we ask these questions. This bunch of stocks that we have actually bought, are the theses actually still valid, right? It's the second question that you want to ask yourself, are there better opportunities out there, right? So in this case, no doubt, if you talk about global tech stocks or you talk about, let's say, Indian tech stocks, the fundamentals are great, right? Post-COVID, e-commerce is not going to go away, there'll be growth. If you talk about EV, it's going to continue. You talk about AI, blockchain, these are all long-term secular trends itself. I hear you, we are also positive on that. But that said, at this point in time, which has got a better risk-reward, right?
Yes.
This year, maybe it's more interesting now in the Chinese tech stocks because the regulations are coming off. In China, there's this, should I say, loosening that's ongoing in terms of policies itself. There's more investor, should I say, investor sentiment will actually now becomes better because now they look at the Chinese tech stocks and they say that, now things are getting clearer. Then this portfolio of money could actually flow back to the Chinese tech stocks, right? So what I'm saying is that, it's always a balancing act, right? On a year-to-year basis.
You got to weigh your options, in a sense.
Yeah, that's right.
And you will always be watchful on what's happening in and around the world. That brings us back to another question: that is it time to bottom fish China?
I think there still could actually be a little bit more volatility in the time being.
Let me stop you there, Limian. For our younger audience, may not understand what bottom fish is. Whoa, what is bottom fish?
Okay,
fish at the bottom.
Meaning that last year, if you look at the Chinese stock market, I think around February, March period, the stock market started to decline over time. So when people say bottom fish, it means that you catch the bottom, right? Whereby the market was actually bottoming out, right? That's the time you actually buy the stock. That's where you catch it. So for the Chinese market, has it reached the bottom yet? Is it on the way up? No, I wish I know, right? the issue is this, right? There could still be some more downside for the time being. There's a few things. 2021, the exports growth were actually fantastic, right? The Chinese actually tend to actually loosen once the exports numbers actually come down for them. A lot of market participants actually expected fourth quarter of last year for the export numbers to actually come down, but it actually remains strong. So there's actually no need to come in so quickly to boost, should I say, to boost the economy again. So that said, in a post-COVID world where the supply chain actually comes back into normal, there's more production in other parts of the world. China that's relatively untouched by this itself because they controlled the pandemic well. There's now more alternatives for them to buy goods from other places. So at that point in time, the Chinese would actually loosen more. So if you look at what is happening now in the Chinese market, is that they are loosening on just the margins itself. So they do this thing, they call it triple R cut, which they call it reserve required ratio. Whatever that is,
reserve
or they do ratio,
yes.
or they actually lowered the lending rate, which in our context is the interest rate itself that you lend to a company. So they are just loosening a little bit on the side itself. They have a lot of so-called policies, a lot of tools at their disposal to help to boost the economy itself. So in this year, when they start to do more and more loosening, that's the point whereby I think the market should actually bottom. And the other issue is also obviously, I've actually explained the idea of new regulations, how much is enough, right? So market participants would want to see that there's actually a lull, meaning that the government comes out and says, oh yeah, we have done what we could. We think we are satisfied with the outcome of it, and as such, we do not see more needs to put in new regulations. At that point in time, the certainty will be there. Investor sentiments will come back, and probably that will be the bottom of the market itself.
Okay, so not yet akan datang in a sense.
I think so, but it's very difficult to actually time pinpoint the market itself. So that's the $1 million or $1 billion question is here. So what investors should usually do is actually, you should start investing into the market itself.
Okay, thank you for that, Limian. Now, very quickly, since we are on the topic of Asia, we got a question from our online audience, and this is specific to Vietnam, okay? And the question is, how come Vietnam fund did so well last year?
Actually,
just probably 1 minute on this question.
Okay.
Thanks.
I think when you talk about Vietnam, you can also talk about some of these countries like India also.
Yes.
It should be interesting. Okay, so I think there's actually a long backdrop whereby, as you probably know, before COVID, we actually have this US-China rivalry, right? So this theme is going to continue for a long period of time in China's ascension itself. So investors, or should I say even companies are thinking, right? Do I place all my bets in just one area, right? In China itself, in terms of, let's say, manufacturing. So the theme out there is always China plus one, right? In the US, US-China rivalry. So companies are thinking, if I don't manufacture everything in China, where do I do it? So in the normal idea is actually to put it in Vietnam, because Vietnam is also a manufacturing hub in Asia itself. And likewise, now they are thinking of also India.
India as well.
So these are, that China plus one is actually a very strong, a fundamental push for these markets itself. For Vietnam, they also have an additional, push for it, fundamental push for it. The reason for that is because Vietnam is actually now considered a frontier market, right? A lot of the stocks itself, they actually have what we call a foreign ownership limit. A few years back, the Vietnamese government was thinking of liberalization, meaning that they will increase the limit itself, they will liberalize the ownership of property in Vietnam and so on and so forth. So these are actually very market-friendly policies. And part of the deal or part of the outcome could also be that Vietnam could actually be upgraded from a frontier to an emerging market, and that could actually lead to a lot of investments into Vietnam. So that story actually took a stop when there was this anti-corruption drive and some of these policies were actually slowed down, right? So that said, now the anti-corruption drive is almost ended. There's this expectation that some of these themes could actually come back in play.
Okay, so what I understand from you is policies really do impact the outlook and the outcome in a sense for any location.
Yes, they do, obviously, right? So, of course, we can talk about the macro strategies, the outlook itself. You should also drill down to what are the individual situation in each and one of the country itself, and also what is the situation of the sector itself before you do your stock pick.
Okay, that brings us to the end very nicely. Thank you for sharing with us so much insightful details and knowledge and wisdom with all of us, especially our audience online on YouTube as well as on our Tiger app. Thank you so much. Once again, this is Chief Investment Strategist, Lion Global Investors, Lim Yun, one of our panel speakers earlier. We're going to move on now to the next theme, the next topic, okay? Still on the Global Outlook 2022. And the next topic is the USA. Prices on the rise. What now? Okay, stay tuned. All right, once again, welcome to those of you on our Facebook, our YouTube, I beg your pardon, our YouTube as well as our Tiger app, okay? We've got in the hot seat right here, Brian Lowe. Brian is the AVP for Financial Institution, Franklin Templeton. Now, very quickly, we're going to be talking about the USA. Prices on the rise, what now? That's the question. Okay, are you ready for this?
I feel very ready for this.
Okay, so I will start you off with the very first question here is what differentiates US companies versus their non-US counterparts? Yeah, what are some of the potential risks?
Exactly, and I think that's a very good question to start off with. And it's great to be here today. I love the setup that we have here today, and I think this is going to be a very exciting
Thanks for taking time to come and join us.
Most certainly. Yeah, and I think, investors in the US, or I would say investors in US companies, should try to also understand what really sets US companies apart, especially if you compare it to the non-US counterparts. And the first thing I would say is that US companies are some of the most global companies that you can find. You think about the exposure for some of the largest US companies, they're not really US companies, they're really global companies. Companies like Apple, Microsoft, you name it, the biggest companies in the US actually have more than half of their revenue coming outside of the US. And that gives investors not just exposure to some of the strongest companies in the US, but in the world. And that's what we always remind investors when you are having an allocation to the US, you're really having exposure not just to the US, but really taking a step out of the US and having that global exposure in your portfolios with an allocation to US companies.
Okay. That's a very good preamble for the discussion we're going to have today. The prices and what now? What are we going to do now? Okay. So with what are some of the potential risks for US equities in 2022?
I think that it's a key question on a lot of investors' minds today. And when we think about the risks, I think we have to also think that the US market has actually been doing really well. Ever since we saw that big drawdown induced by the pandemic, and we really saw a V-shaped recovery. So the first thing that I would note is that kind of growth is probably going to be tapering off, but we can still expect above average type of growth into the US. Secondly is some of the headwinds, potential headwinds on the macro front. We are expecting quite a fair bit of interest rate activity, especially when we think about rate hikes coming out of the central banks, the Federal Reserve in the US, and that could also be accompanied by potentially persistent inflationary pressures, and that could destabilize some of the stocks that investors might be investing in, right? And I think those are some of the key areas that investors would want to be concerned about.
So that brings us to, besides the concern and the performance of the US market, with US equities recording another strong year last year, 2021, what's the outlook for 2022? Moving forward?
And I think that one way to actually share with everyone what this actually holds is to really just pull out some of the content that we have prepared for everyone here today.
Let's take a look at it. So for our audience online, just before Brian shares with us, if there's anything you really want to see, you can just do a screenshot of the fabulous information that a lot of our speakers have prepared painstakingly, done the research for all of you. This is purely for all of you on our YouTube and our Tiger app, all right? Sure. Brian, back to you.
When we think about the kind of growth that the US has seen, it's not just stock prices that have been going up. It's really also the amount of output that the US has been producing. So, I talked earlier about we saw that sharp drawdown in March of 2020 and that subsequent V-shaped recovery that we are seeing here on the screen. And what is interesting and important to note is that following what we saw was really the shortest and deepest recession on record that we have had.
It is indeed.
The US economy has actually recovered all that lost ground and continues to grow beyond pre-pandemic level. And this is very important because not all the countries or regions in the world can actually say this thing. So this puts the US in a very strong position to continue that kind of success, as we look out into 2022. And overall, as I mentioned also a bit earlier, the kind of growth is expected to remain healthy, even though we expect some tapering off of the growth. I don't think we continue to expect a very strong type of sharp, V-shaped recovery. But actually what is also good to note is that for the subsequent years ahead of us, at least until the first quarter of 2023, we are expecting somewhere between, on average, 4 to 5% of average GDP growth.
And that's still pretty good, right?
It's pretty good. It's pretty good. Two things to note, it is a level that is pretty good, and secondly, it's a level that is quite above the long-term average of around 2%, and also something which not a lot of other regions or countries can actually optimistically project.
Wow, interesting.
So, that really informs us on the overall continued consistency that the US, we expect to be actually showing us and investors, in the year ahead of us.
Okay, that is really insightful, and I think the figures speak for themselves. But we want to know, how can a macro backdrop of monetary policy, inflation, and the pandemic shape the landscape in the coming year, this year, 2022?
Yeah, I think that there would be a few shifts that we are seeing. I think that when we think about some of the key changes that we as investors might expect from the macro backdrop, we are expecting a few interest rate hikes. A Fed, that looks to be quite bullish. They want to not just hike rates, but potentially pull back that easing, that the liquidity that we have seen being put into the economy. So that means that the amount of liquidity in the system may not be as high as what we are seeing right now.
Yeah.
So that means that not all companies will be able to confidently navigate this as easily as perhaps when there was a large pool of liquidity in this space. So investors need to be discerning. They need to stick to companies which have good quality, strong cash flow growth, good businesses that can allow these companies to navigate this macro backdrop, at least for the better part of this year.
So in a sense, to really look at the tried, tested, proven kind of companies.
Definitely.
Okay, we hear you. Now, very quickly, just asking personal questions right now, throwing you off tangent here, off your feet. For yourself, when do you start getting interested in the US market? And what was the journey like?
Yeah, you know, I think that...
How young were you firstly?
I would
how
say
many years
that-
must we rewind? You look pretty young, by the way. I think he's one of the younger ones you've had here at WWTD 2022, right?
Thank you very much. I'm in my early 30s, I would say.
Okay.
So, no, I think that that's an interesting anecdote that I would also like to share with everyone. I think I began interested in the US really when I started to become interested in the tech space. That's where, you know, there's so much vibrancy in the technology space, and when you think about what happens in Silicon Valley itself, you know, where 50% of venture capital and private equity deals flow through every year, I think that's where so much of the activity is happening. So I really became interested in the tech space, some of the leading tech companies back then and today, and then that also got me interested in the US as a region and the kind of opportunities it can afford and can potentially continue to afford to investors.
So how long ago was that when you started?
I think the interest really started when I think towards the tail end of my days in college.
Okay. So that's close to a decade, huh?
I would say
about
so,
that.
yeah.
Okay. I will not give his age away. but the reason I ask that is because I'm sure some of the audience, for them, this is new. Or maybe their journey of investment is just like us riding a bicycle with two wheels by the side.
Sure.
It's new. And for them, they have a lot of questions that probably we had when we first started as well. And it's important to also try to get that from all our speakers, you know. They are here today because of the first few steps. You know, they always say a journey of 1,000 miles begins with a step. And I think for us, we started a step early. And for those of you listening, if there's any questions you have, you know, don't be shy. Just type it in the comment section, even on YouTube, and especially on our Tiger app, so that we can answer the questions and we can, of course, have our esteemed speakers answer those questions. Okay? So, moving on, Brian, to the next question. What are the key drivers for continued growth in this US market?
And this is actually one of the most important questions
That's right.
to note. And there's just one key word, and that is called earnings. And I have a couple of content that I really wanted to show, which would bring out what we really are looking out for.
Please do.
So US stocks today have grown into their high valuation. So one of the key concerns that investors would have are, you know, really, how much more can US stocks continue to grow? And the key answer, which we have also identified quite early on, is earnings. So US stocks today, and we are just looking at very briefly the third quarter of last year, across all sectors, you can see very, very strong and positive earnings across sectors, not just some of the fastest growing sectors like technology and consumer, but really it's all across the board. And
it is.
And you're really looking at some of the all the key sectors in the S&P 500.
Yeah, and even utilities too.
Exactly. So what we're actually looking at is what we call a broad-based recovery.
Yes.
You know, and this actually shows us very well that the recovery that we are looking at in the US, that kind of GDP growth above pre-pandemic levels, all sectors are in a way contributing to that growth. We're not just looking at, just technology, you know, or some of the high growth sectors that is contributing to this type of recovery. It's actually quite broad-based. If you take a look over the longer term, earnings have continued to recover, beating expectations more often in recent quarters. The chart on the left-hand side is actually quite instructive. This is what we call earnings per share. So earnings per share is really just EPS. We look at broadly how much a company is earning as a broad measure over the past decade. Now, first and foremost, let's take a look at earnings at the pandemic era. Okay, so it's quite on the right-hand side of this graph. You're actually seeing that earnings took a very huge hit
Yes.
during that drawdown.
The dip, another V lah in a sense.
Exactly.
The start of the V.
The start of the V.
Yeah.
And you really saw a V-shaped recovery in earnings itself. So stock prices have recovered very robustly. This is also accompanied by earnings recovery. If you take a long term, since 2010, in the last decade, earnings per share in the S&P has actually tripled.
Wow.
Okay? And when you look at stock prices in the US, they have also more or less tripled. So we can actually see that earnings in the US, or I would say the stock price growth in the US, the S&P 500 growth, and broadly speaking, US equities growth, has actually been quite aligned to the kind of growth that we have been seeing for company earnings. So, which is why we say that the strength and the robustness of corporate earnings would continue to be a key driver of growth. Just take a look at 2021. We all know that the S&P 500 gave us 27%.
Yes.
Very strong returns.
Very strong, especially in the US.
Exactly. And what investors should also understand and know that S&P 500 earnings companies have grown by 25%.
Wow.
So you can see that actually that is in line. So
the growth, let me just stop you there for a while. The growth of the company, in a sense, it's correlated, right, to the growth in the market.
Yes.
Yeah.
Yeah. So
rightly so.
Rightly so. And because of this measure, we don't necessarily see the stock market necessarily being overheated.
Yeah.
Because we see it being accompanied by strong growth in the earnings and profitability.
Okay. Wow, those are really insightful. I always say and appreciate, numbers really don't lie. They really tell you a story, not just about the growth of the market. They tell you the story about the growth of the companies as well, and how healthy these companies are. And more significantly, I think the general theme that I've heard throughout the past few speakers is that, yes, COVID has changed the lives in one way or another, our lives in one way or another, but you see the resilience and the goodness that is brought out of that in some way or another is that we bounce back in one way or another. And I think there's hope, even in light of Omicron and possibly any other variant that comes along, because, COVID is here to stay in a sense, but we always want to make sure that we stay hopeful, right? And just as we talk about the different countries, as we geographically look at the outlook in 2022 from Singapore, China, Asia Pac, APAC, right now to US with Brian here. Once again, if you've got any questions, our online audience, okay, write it down in the comment section and we'll be there with you. Now, Brian, you mentioned one keyword just now. What is that keyword?
The keyword?
Yeah, just now. Earnings, right?
Yes.
Okay, so as you heard from Brian, the keyword is earnings. The first 5 of you that write earnings in the comment section will walk away with Tiger Coins. You will earn Tiger Coins, right? You heard me right. My name is Mark, but I'm also Chai Sen Ye lah. Okay, all right. For our non-Mandarin speaking audience, that is the God of Fortune. Okay, so I'm giving you coins. Okay, just type down earnings, the word earnings, EARNINGS. Okay, the first 5 of you walk away with Tiger Coins. All right, now very quickly, back to Brian on the prices on the rise and what now. For US. We're just going to take things in perspective of how it is locally as well in Singapore. Now, how are some ways we, in a sense, Singapore's market can hope to achieve that same growth, or that, what can we learn, in a sense, from the growth in US?
Yeah, I think that one of the things that the US actually affords, firstly, let's just take a step back and think about the scale of the US market.
Yes.
The US as a country is probably less than 5% of the world's population, right? But the country itself accounts for 25% of global GDP. That speaks volumes, And again, just to remind everyone, for a country that has 25% of global GDP, you have to have some allocation.
Yes.
And I think that hopefully puts things into perspective. And there are a lot of drivers and a lot of areas that I think we can also learn from, or as we look at how the US has been in the past few decades. I think one of the areas is that the US continues to be a very innovative space.
Yes.
Now, a lot of the innovations that we have in our lives today has more or less come out of the US, and it has actually sort of redefine a lot of our experiences as we know it. And a lot of these are US companies. So I think that if there's one thing that I think would really benefit us in Singapore is to really think about how we can also learn from the innovative spirit of
US counterparts.
The US counterparts of the Americans.
I hear you. Indeed, a very key point that Brian pointed out is that it's 5% of the world, but yet they control a quarter of the market. Interesting. We in Singapore, we are very small as well. But let's look to them in a sense, in that fervor and in that motivation to become a little bit larger. Now, we've got we've got some questions from online. And this question here is, are growth stocks going to be growing less in 2022 in view of inflation and interest hike? Okay.
Certainly. And I think that that's a question that is very relevant. And if we can pull out some of the content there, I actually do have something that do address this hopefully quite well. When we think about growth stocks, so let's think about a combination of growth and quality stocks, right? Generally speaking, as countries transition towards living with COVID, what we have actually seen is that growth and quality stocks have actually been in favor. So the gray lines or the gray area that you see is really the kind of cases or the 7-day moving average. So it's really just a measure of cases in the US. And this was in a time of Delta.
Yeah.
Right? Of course, today we're talking about Omicron. During this whole period of time, the whole stretch of time, what we've actually seen is that growth stocks and quality stocks have done better than their value counterparts. So we are looking at the blue line tells you the large cap growth stocks against the large cap value stocks, as well as the green line shows us quality stocks against small cap stocks, right, the Russell 2000. So one thing is very clear is that in the period of COVID, or at least in this case when countries transition to living with COVID, with the up and down of the Delta wave, what we've actually seen is that during this period, growth stocks and quality stocks have done better than their value, as well as their quality small cap counterparts. Of course, this may not be the case looking ahead, because one of the things that would be coming into the picture is interest rates and inflation. Interest rate hikes as well as inflationary pressure. In the short term, we think that this is going to perhaps put a bit more of a pressure on higher growth names. Really, because when you valuations for companies, they tend to be discounted quite far into the future. When interest rates goes up, the present value of what you discount goes down. It drops down because interest rates goes up, and that is quite typical. So we are going to see a little bit of an adjustment in the growth space. At the same time, we also want to look at not just growth, but growth and quality, right? So companies can be growth stocks, but sometimes they may not be very good quality. These are some of the companies that you may necessarily want to have.
Can I just stop you there very quickly? Can you give us some examples of those that are growth, but if you can think a few. Sorry to put you on the spot.
No problem. Okay, I'm going to maybe share
from personal experience.
Certainly. So we want to talk about growth, but perhaps quality may not necessarily be that. Okay, why don't I give you a good name which has both growth and quality? This would put things into perspective.
Sounds good.
Right. I'm gonna use a name that everyone knows very well.
Okay.
And that is Apple.
Yes.
Apple is a true innovator in this space.
Definitely.
It has redefined the way we communicate with the introduction of not just the iPhone, but a lot more other hardware and software. And it continues to be a company that has strong growth potential ahead.
Yes.
And it's not just the kind of growth that we're looking out for, it's also the quality of growth. If you look at Apple, it is probably one of the best managed companies you can find in the world. And this is because of the quality of the businesses, the quality of their management, and really how they think about their business. So when you think about these two factors coming together, we think that growth combined with quality is what we want to look out for. And they necessarily may not be that much impacted by the threat of inflation and interest rate hikes.
Yeah, they'll be a little bit more resilient in a sense. Am I right to say?
I would say that, yes.
Okay. Interesting. So are we done with what you were sharing with the audience earlier?
Yes.
Okay. Now, let me see whether there are any more questions from online very quickly. Okay, there are none. Okay, but we'll just go on to another question just here off the cuff right now, Brian. For US, particularly in the US market, right? What are some ways for our audience, if they are new especially, and they have not invested, or probably they've invested in one or two, a few,
Okay.
right? What are some ways they can grow their portfolio in a sense, or perhaps evolve and go further down this journey?
Yeah, I think that's a very, very relevant question that
for our audience.
for our audience, and I think it's something that we should also take note of. I think that investing should be a long-term journey.
Yes.
I know in the short term there could be news or macro headwinds that everyone would be nervous about.
Yeah.
But over a long term, I think what you would realize is that those things don't really matter. Because it's worth remembering that over the long term, the market tends to move up. That has been the case in the decades before us. We are positive that that is also going to be the case as we look ahead. And if you have a long-term perspective, I think that definitely is something that's going to be very helpful as you think about how you continue to grow your wealth as part of your investing journey. The other area which I would also point out is probably to start as early as you can, and you don't have to start very big, right?
Yes.
You just need to start small, set a small sum, at a regular basis and put it into the market. Over the long term, I'm optimistic that you would see that portion of your invested wealth grow as well.
Mm-hmm. We hear you. Now, earlier, one of the speakers, the panel speakers, Pang Chi, if I'm not wrong, shared with us he started in his college years, pretty much same as you. He started with about $100 of investment. Now, I'm not going to ask you how much you started with, but I just want to ask your current self now, if you were to turn back time and speak to a younger self when you're just about to embark on this journey, what are the top 3 advice that you would give yourself?
Well, I think that continue to always be curious.
Okay, to
really
be curious.
Find out more about things,
Yeah.
right, and have that.
Be informed.
Yeah, informed, and that curiosity within you, so that you would be able to discover new ideas, new opportunities, which would always be helpful, right, towards this journey. Secondly, I would probably also say, I think I could have started a bit earlier when it comes to investing.
How early you want to start? College is 18 or 19, you know?
Yeah, I think that.
15,
that's around there. But if I could do it a bit earlier, I wouldn't complain.
That's why he's here, ladies and gentlemen. Truly an expert in his craft. That's why so young he's here. And he still wants to start even younger. So this is just very quickly to our audience on YouTube and Tiger app. This is also impetus for those of you that are considering to embark on this journey. Why not start now? We've got a starter pack here for Tiger Brokers. Anytime, just scan the QR code. Later I'll share it with you. And very quickly now, you mentioned 2, okay? To be curious and to always seize the opportunity. And what's the last one?
The last one is to really just have faith in the investments that you do. Because have faith, because have faith, read widely, be curious, and always know that in some way or another, your decision could really turn out to be the right one. Because if you start to have doubts, into the investments that you make, you may actually miss out some of the longer term gains that could be in store. And I think that you don't have to pick specific stocks if you're unsure about that, but I think a good way to start is to think about investing broadly in the market.
Yes.
And there are so much funds and instruments out there that allow you to do that.
Yes.
And also have faith in the investments that you are actually doing, because over the long term, more often than not, there tends to be longer term growth in store for investors.
Yes. Like you mentioned earlier, through the decades, even decades before us, it's always on the upward trend of growth. Regardless, even if you showed us the graph just now about how COVID numbers have that were on the rise in the grey area, but yet we see the growth happening still in the US market.
Yes.
Of course, we talked about the V shape earlier in the graph. Now, very quickly, we're going to move on to probably our last question before time runs out with you, Brian. The last question was there just a moment ago, but it seemed to be disappeared. No worries. We're going to ask another organic question, Brian.
Sure.
So, just now you mentioned about being curious. Help me understand, and as well as our audience, being curious is not just really about watching the numbers. Being curious is also about understanding the companies, understanding the growth. Like you mentioned, you need to know the quality of the company as well. So how would you rate it? Is it just purely looking at numbers? Like, is there a percentage where you just really market watch, or you need to read up about the companies and all? How will you divide that? Or is it a 50-50 kind of thing?
Yeah, I would say it's a more balanced approach. You know, try to find out more, read broadly, and try to get a more complete picture, and then probably go into some of the areas that you really want to focus on, which you might probably think is important. So definitely do quite a broad type of understanding, get a broad picture, and maybe even go deeper into some of the areas that you like to find out a little bit more. Definitely pay attention to some of the numbers, because like I mentioned earlier, if you are looking at investing in perhaps a company or in the market, earnings are very important. So you need to really look at what
the numbers,
earnings are actually like, right? And have a sense of how the company is probably going to perform, how the investments that you have are probably going to perform in light of certain macro environments, and I think that's very important. Read some of the expert analysis that you can find all over the internet, and I think those are very useful resource. And yeah, just really be curious, stay close to the news, and don't panic too much about your investments, because I do think that you need to have a bit of that faith.
Have faith, right?
Yes, that things will eventually turn out for the better.
So in a sense, have faith in yourself. That's what you're trying to tell the audience. Have faith in yourself in three different ways. In the work that you do, in being curious, in understanding the market as well as the companies, the quality as well as their performance in a sense, and also have faith that you trust your prediction, right, or the research that you have done, and have faith in the companies that you have invested in. Well, okay, very quickly, back to our audience, for customers, or rather for our online audience, please check out our community user at FundMall for more beginner investing tips. Okay, once again, for those of you that are interested, check out our community user at FundMall. That is at FUNDMALL for more beginner investing tips. Now, very quickly, once again, back to Brian. Before we say goodbye, because it's time for lunch over here in Singapore, any final words for our audience online?
No, I think that I would just maybe put a quick summary of what perhaps
what now?
Yeah, as investors, you might probably want to look out for into the US market. And with that, I think I would look at my last page, okay? And that's where I like to put my summary in.
Sure. All right, just bear with us as we get the slides up. Okay, there we go, the upshot.
The upshot, and this is what, as investors, we also want to think about.
Yes.
So we believe that the bull is well. There is optimism, continued optimism in 2022, but beware of potholes from areas like monetary policy, right? Rising interest rates, inflation, and of course the pandemic, which is still ongoing. Yes. The first one will be to stick to quality, right? Not just growth, but growth and quality. Right? Market fortunes would probably favor companies that have good quality businesses, strong cash flows that can allow them to navigate this, changing winds, right, at the macro level. At the same time, exposure to key secular growth trends remain essential. I think the pandemic has accelerated some of these trends.
Yeah.
It would probably redefine a lot of the things that we see, the things that we live, and how we work and how we live. So exposure to some of these growth trends and themes continue to remain essential if you want to be ahead of the market and to capture a lot of the gains ahead of you. And at the same time, do stay active in your portfolios to think about how you can confidently navigate, right, what is in store for us, and also come out stronger at the other end for the rest of this year.
All right. Thank you so much, Brian, for that very nice summary for us here on the topic of the USA, prices on the rise and what now. That brings us very nicely to the end of the morning session here on the very first day of WWTD, Investing Tomorrow, Today. That brings us to the end of the morning session, as I mentioned. We'll be back in an hour's time, okay, for the afternoon session, and we're going to be talking about the thematic outlook, thematic market outlook for 2022. So stay tuned, enjoy your lunch, and wherever you are in the world, stay safe and be happy and hopeful. I'll see you later. you.